This course will develop a comprehensive understanding of financial analysis, investment strategies, and capital structure optimization by integrating accounting principles and financial management techniques to support informed decision-making. They will develop skills in intercultural communication, enabling them to effectively engage in global business environments, lead change management initiatives, and collaborate across diverse cultural contexts. The course also emphasizes strategic leadership, incorporating STEM knowledge to foster business innovation, drive organizational transformation, and support sustainable growth. Ethical considerations and corporate social responsibility will be central to the curriculum, allowing students to critically evaluate the broader impact of business decisions. They will explore ways to enhance diversity, equity, inclusion, and accessibility (D&A) within organizations, ensuring that all employees feel valued and empowered to contribute. Additionally, the course will examine global business trends and cross-cultural management practices, equipping students with the necessary skills to operate effectively in international markets. By integrating these key competencies, students will be prepared to navigate complex business challenges, lead diverse teams, and implement forward-thinking strategies that align with both financial performance and social responsibility. Business financials encompass the critical metrics and reports that define a company's financial health, guiding strategic decisions and operational planning. Through financial statements such as the balance sheet, income statement, and cash flow statement, businesses gain insight into profitability, liquidity, and overall stability. These financial records help stakeholders assess revenue generation, cost management, and investment potential while also ensuring compliance with regulatory requirements. Analyzing business financials involves interpreting key ratios, identifying trends, and making data-driven decisions to optimize growth and sustainability. Effective financial management supports budgeting, forecasting, and capital allocation, enabling businesses to navigate risks and seize opportunities in a competitive market. By understanding financial performance, organizations can enhance efficiency, secure funding, and drive long-term success. Analyzing financial statements is an essential process for evaluating a company's financial health, performance, and overall stability. By examining key financial documents such as the balance sheet, income statement, and cash flow statement, individuals can assess profitability, liquidity, and solvency. This analysis provides valuable insights into how efficiently a company generates revenue, manages expenses, and sustains operations over time. Financial statement evaluation involves methods such as ratio analysis, trend analysis, and benchmarking against industry standards to identify strengths and areas for improvement. Investors, managers, and other stakeholders rely on this process to make informed decisions regarding investments, creditworthiness, and strategic planning. Understanding financial statements also helps organizations anticipate financial risks, optimize resource allocation, and improve long-term sustainability. By integrating financial data with market trends and economic conditions, financial analysis becomes a powerful tool for guiding business decisions and achieving organizational success. Here is a detailed summary of the document, Cash Flow Ratios Under Growth Approach as an Indicator for Evaluation of Business Performance, by Ayan Majumdar and Debabrata Majumdar. 1. Introduction and Purpose of the Study. The paper examines the usefulness of cash flow ratios, particularly when analyzed under a growth approach, as indicators of business performance. The authors begin by emphasizing that sufficient cash is essential for the smooth functioning of business operations and for meeting obligations as they become due. A cash flow statement records the movement of cash into and out of an enterprise through operating, investing, and financing activities over an accounting period. Under IND-AS 7, the objective of the cash flow statement is to provide information about historical changes in cash and cash equivalents. The standard allows the use of either the direct or indirect method, but this paper focuses only on the indirect method. While financial analysis traditionally relies heavily on accounting ratios, such as return on assets and profitability ratios, IND-AS 7 does not prescribe specific cash flow ratios. The authors note that limited structured development of cash flow ratios exists in accounting literature. Therefore, this study adopts and applies selected cash flow ratios proposed by earlier researchers. The primary objective of the paper is to determine whether cash flow ratios, especially when combined with a growth approach, provide better insight into liquidity, financial flexibility, and performance evaluation. 2. Literature review. The literature review highlights the objectives of INDAS 7, which include assessing an entity's ability to generate cash and meet obligations. However, the standard has been criticized for lacking clarity regarding the definition of operating activities and inconsistent treatment of interest. Prior studies have compared traditional financial ratios with cash flow ratios. Research in Sri Lanka found that traditional ratios often produce different results compared to cash flow ratios when assessing liquidity, solvency, and profitability. The concept of sustainable growth is discussed using Higgins' model, which defines sustainable growth as the maximum rate at which a firm can grow without altering its financial leverage. The paper treats growth rate and sustainable growth rate as conceptually similar. The authors argue that cash flow-based performance ratios are not new, but historically their use was limited due to lack of data. With mandatory cash flow reporting, such ratios can now be effectively applied. 3. Traditional financial statements and cash flow statement. The study uses a hypothetical company, ABC Company, and presents income statements for 2012 to 2016. Balance sheets for 2012 to 2016. Cash flow statements prepared using the indirect method. An alternative algebraic form of the cash flow statement. From the financial data shown in Exhibits 1 to 4, sales increased substantially from 19,327,000 rupees in 2012 to 73,400,000 rupees in 2016. Net income also increased over the period, although with fluctuations. Operating cash flows are derived by adjusting net profit for depreciation, interest, taxation, reserve transfers, and changes in working capital components such as inventory, receivables, payables, and short-term loans. The alternative cash flow presentation expresses net cash flow algebraically in terms of sales, costs, expenses, working capital changes, fixed assets, capital, and long-term debt. This format demonstrates the structural linkage between profitability and liquidity. 4. Growth approach. The authors introduce a growth approach by calculating an annual growth rate based on sales growth between 2012 and 2016. Using the formula G equals final value / starting value caret 1 / years 1 times 100. The annual growth rate is calculated as 40%. Under this growth assumption, projected financial statements are prepared. Income statement under growth approach. Balance sheet under growth approach. Cash flow statement under growth approach. Key assumptions include sales, cost of goods sold, and depreciation grow at the calculated rate. Income tax is calculated based on projected profit. Inventory, receivables, short-term loans, and payables grow proportionately with sales. Long-term debt remains constant. Net fixed assets grow in line with projected sales growth. The growth approach therefore integrates projected expansion into financial statement analysis rather than relying only on historical performance. 5. Cash flow ratios used. The study adopts 8 cash flow ratios based on Giacomo and Mielke's framework. These ratios are calculated both under traditional historical cash flow statements and under the growth approach. The ratios include cash flow adequacy ratio, long-term debt repayment ratio, reinvestment ratio, debt coverage ratio, impact of depreciation write-off ratio, cash flow to sales ratio, operating index ratio, cash flow return on assets. These ratios evaluate sufficiency, solvency, reinvestment capacity, asset productivity, and operating efficiency based on cash flow from operations rather than accounting profit. Exhibit 9 summarizes and compares ratios for 2013 to 2016 under both methods. 6. Key findings and interpretations. The analysis shows the following patterns. Cash flow adequacy. The ability to generate sufficient cash to meet long-term debt and asset purchases was stronger in the earlier years. Both traditional and growth approaches produce similar trends. Long-term debt repayment. Cash flow ratios show stronger repayment capacity except in 2014. Growth approach ratios are comparatively lower in most years. Reinvestment ratio. Traditional cash flow ratios generally appear stronger, though both approaches show high reinvestment in 2015. Debt coverage. Traditional cash flow ratios show steady growth over time. Growth approach ratios are somewhat weaker but follow similar directional trends. Impact of depreciation write-off. Traditional ratios show stronger effects of depreciation adjustments compared to growth-based ratios. Cash flow to sales ratio. Both approaches show similar trends. Cash conversion relative to sales remains modest and fluctuates. Operating index. This ratio shows volatility and negative values in certain years. Growth approach ratios are stronger in most years except 2014. Cash flow return on assets. Growth approach ratios are stronger in most years except 2014, suggesting better projected asset productivity under growth assumptions. Overall, while individual ratios vary, both methods show broadly similar trends across years. However, growth-based ratios often appear stronger, suggesting improved projected financial strength under sustainable growth assumptions. 7. Conclusion. The paper concludes that cash flow ratios provide better analytical power than traditional accrual-based ratios for evaluating financial strength and predicting distress. When combined with a growth approach, cash flow ratios offer enhanced insight into liquidity, financial flexibility, and long-term sustainability. Although the study focuses primarily on operating activities, the authors acknowledge the importance of investing and financing activities in supporting operations. The overall conclusion is that cash flow ratios, whether analyzed with or without growth adjustments, reveal consistent trends. However, incorporating the growth approach provides a more forward-looking and comprehensive assessment of business performance. The study supports the view that cash flow-based analysis can improve financial decision-making for investors, creditors, and corporate managers. Insolvent companies negatively affect on the country's overall social and economic development. In Republic of Latvia between 2011 and 2016, each year an average of 870 companies was being proposed with insolvency. In order to minimize or avoid the company's insolvency, it is important to timely evaluate companies' business activities and to take appropriate decisions. Company performance analysis can be made with traditional financial analysis ratios, which are calculated by using the balance sheet and profit and loss statement data, but based on the views of theorists and authors' previous study results, it is also important to use the cash flow statement data analysis. In the research were used 50 freely chosen, in the Republic of Latvia registered companies whose insolvency procedure started in the period from November 1, 2014 to December 31, 2016, and which operate in one of the four following sectors: trade sector, transportation, sector of services, or production. In order to rapidly assess the company's ability to pay, thereby avoiding the possibility for the company to fall into the insolvent company status, the authors put forward the objective of the study: explore, compare, and assess the solvency indicators, which are calculated using the traditional methods of financial analysis and cash flow statement, developing proposals for solvency prediction. To achieve this goal, there were used economic analysis and synthesis method, studying the theoretical aspects and corporate reports, statistical methods, data processing and analysis, as well as the logical constructive methods of interpreting the results of the study, setting conclusions and recommendations. In the research, there were defined conclusions and formulated proposals for companies' business analysis in order to timely detect and avoid the corporate insolvency. The most important of them are included in the conclusion part. The article has a theoretical and practical meaning in solvency forecasting through traditional financial situation evaluation ratios and cash flow statements. Keywords: cash flow statement, cash flow ratios, financial analysis, insolvency prediction. JL code M41 M49. 1. Introduction. Company's added value is the basis for not only the company's development, but also for the country's overall development. Therefore, any economic entity is interested in to the company which operates in the long-term run, because if it develops, there can be designed not only higher level of profit, but also new jobs, and that can broad up national prosperity. However, long-term development is not possible without systematic monitoring of company and its ability to efficiently use all resources. Working with financial information and analyzing it is necessary to explore many details and elements that could have a significant impact on the financial position and stability. According to the author's opinion, it is necessary to examine both the income statement results and cash flow statement. Both of these statements' comparison can provide important information. It also stresses Lukopoulos and Rupas, 2014, in their work Financial Analysis of the Greek Private Health Sector over the Last Decade, 2002 to 2012. The comparison between earnings and operating cash flows informs us about the amount of the accrued profits and hence on the quality of accounting information. Generally, the difference between these figures and their volatility is not desirable. Ever since the early 20th century, when its origins lie in the financial analysis, that time and contemporary authors argue about traditional financial situation assessment methods. However, according to the authors, for objectivity also it is necessary to use the information provided by cash flow statement. In order to achieve the goal of the study, to explore, to compare and assess the solvency indicators, calculated using the traditional methods of financial analysis and cash flow statement, and as a result develop proposals for solvency prediction, the authors put forward the main tasks. 1. To compare the cash flow statement of the information provided by traditional financial analysis methods and their information. 2. To perform 50 insolvent companies' financial position representing by 4 different industries cash flow ratio analysis and traditional financial analysis factor assessment. 3. To make 50 insolvent companies representing by 4 different industries financial position, cash flow ratio analysis and traditional financial analysis ratios assessment. 4. To compare the cash flow ratio results with traditional financial analysis ratio results. 5. To make conclusions on the cash flow statement importance in the company's solvency evaluation. 6. To make proposals in order to improve the company's solvency assessment using the cash flow statement information. For the research object, were determined 50 freely selected companies that at first were grouped according to the following criteria. Companies that are registered in Republic of Latvia, which in the period from November 2014 to December 2016 started insolvency procedure, and which following the Article 54 of the Annual Account Law requirements, had prepared a cash flow statement for at least 5 years prior the insolvency proceedings initiating, and which operate in one of the 4 following industries: trade, transport, service, or production. Analysis of 50 selected companies in 4 different industries were selected out of 110 companies that met the author's set requirements for selection criteria and for which an insolvency procedure was started in the period from November 2014 to December 2016. In order to provide the widest possible and accurate summary of financial ratios calculation results, authors used different mean values to display absolute values and ratios results. However, all were based on the mean values in order to more visible and more accurately show the results. Overall, to the data analysis, authors used the following mean values techniques: arithmetic mean, median, arithmetic mean, which calculation is based on the values of which excluded outliers values, arithmetic mean, which calculated with Excel formula Trimian, and which is based on the arithmetic mean, but from which, at first, were excluded common data series with its upper and lower values in excess of 2%. 2. Research results and discussion. 2.1 Financial analysis ratios used in solvency assessment. The need for measurable methods to make credit and investment decisions was the main reason for the initial financial ratio development. Financial ratio analysis origins found in the early 1900s by the ratio, current assets to current liabilities, Patterson, 2001. Before the Financial Accounting Standards Board issued Financial Accounting Standards No. 95 Statement of Cash Flows in 1987, specific information about the actual cash flows as whole was not available. Studies before 1987 in ratios, which were necessary cash flow measurements, usually were used a combination of indicators, net profit plus depreciation. But with that was missed information on the funds arising from financing and investing activities, Patterson, 2001, Thalassinos et al., 2015. The authors notes that the main reason for the cash flow ratio development was the fact that the studies were based only on the ratios, which are based on accrual basis. In that time, researchers realized that the precise ratio interpretation required ratios with cash flow statement information. In order to compare traditional financial analysis ratios with ratios based on cash flow statement, the authors in choice of the traditional financial ratios were based on different in literature sources founded. The most popular bankruptcy forecasting models reflected in the other researchers' set financial ratios, with which, in their view, in different combinations can be predicted impending insolvency. The authors analyzed a total of 9 different literature sources, which was reflected in the comparison of solvency and forecasting models found in the financial analysis ratios, which were researched and discovered by 13 different authors. Most of the 6 most common traditional financial analysis ratios among all of authors viewed literature sources: Subramaniam, 2014, Elliott and Elliott, 2006, Patterson, 2001, Bukovinsky, 1993, Snyder, 2009, Imanzadeh et al., 2011, Hussain and Pambekti, 2014, Sembiring, 2015, Hua, 2006, Denisova et al., 2017, Leopis et al., 2013, Lado Gonzalez and Calvo Dapico, 2017, Boldianu and Tach, 2016, Theria, 2015, were various ratios which common feature was that they were confronted with total assets, a total of 5 of the 6 most common factors, but 1 were opposed to current liabilities. The authors' 5 selected financial ratios were selected to assess the solvency level, therefore, studied financial ratios and mainly were related to the solvency and liquidity assessment. According to authors, important insolvency forecasting indicator is an asset's efficiency level as evidenced by the Lukopolos G. Rupas T. In their research, asset turnover is the second key factor that determines the performance of equity. Lukopolos and Rupas, 2014, so the authors chose to look at the ratio net turnover/total assets. Solvency evaluation is often associated with capital structure analysis. However, about the amount of debt on the balance sheet have different opinions. Modigliani and Miller, 1958, are the first that have tentatively studied the impact of capital structure. In their studies, they demonstrate that the value of a firm is independent of its capital structure and, consequently, there is no correlation between leverage and firm's value in a world without tax and transactions costs. El-Shirani, 2014, thereby the authors chose to look at the financial analysis ratios that associated with the capital structure evaluation. The authors generally chose to study 3 ratios that were related to the assessment of solvency, a ratio associated with liquidity and a turnover ratio, which are reflected in Table 1. This study used 5 on the cash flow statement-based ratios selected to assess the company's ability to pay as accurately as possible, which based on the most important of the previous study, of the cash flow statement analysis useful ratios, results in which were compared and eliminate liquidated and operating companies' cash flow ratio results. In this study, it was distributed to the main cash flow ratios, which showed the biggest difference between the liquidated and operating companies, Steinberger and Millera, 2016. The authors chose a total of 10 financial ratios with which to analyze the insolvency probability in the future. 5 of them were traditional financial analysis ratios, which according to the author's opinion were the most important ratios for the assessment of the insolvency, and 5 ratios that the most significant differences showed in the previous research, and were based on the cash flow statement. In the following study, the authors will use, according to authors, main ratios in the analysis which summarized in Table 1, showing separately the traditional and on the cash flow statement-based ratios. Based on the authors selected and the above mentioned a total of 10 different ratios, which are based on cash flow and balance sheet and profit and loss account data, will be analyzed 50 different companies whose has insolvency procedure initiated. In order to assess the cash flow statement importance in solvency assessment and compare the results obtained with traditional financial situation assessment methods results. 2.2 Insolvent companies' financial statement analysis in service, production, trade, and transport industries. 50 companies which insolvency proceedings were initiated during the period from November 2014 to December 2016 for the analysis were selected using the following criteria. Publicly available information about the company's operations and, on the above-mentioned period, were initiated insolvency proceedings, publicly available annual statements, which contain cash flow statement for at least 5 years before initiation of insolvency proceedings, companies operating in one of the following sectors: service, production, transport, or trade sectors. Of 110 to the selection valid companies, first were selected those companies whose financial statements contained the financial information necessary for the ratio's estimates. From the list of beneficial companies were randomly selected 50 companies, which can be seen in Table 2, according to their industry affiliation. The author carried out a financial ratio calculations and analyzed them, comparing different ratios and the application of statistical methods in order to assess the ability to predict the impending insolvency of using these ratios. In order to analyze companies and ratios, were used various of calculation methods, however, all were based on the average calculation. Beaver, in his study which were published in 1966, to display data, also used averages. Beaver divided ratio components and calculated the average values of the bankrupt companies and operating companies. The analysis of average value of these components revealed a significant difference between the bankrupt and operating companies in various fields. Bukovinsky, 1993. Overall, to the data analysis authors used the following mean values techniques: arithmetic mean, median, arithmetic mean which calculation is based on the values of which excluded, outliers, values, arithmetic mean which calculated with Excel formula trimian and which is based on the arithmetic mean, but from which, at first, were excluded common data series with its upper and lower values in excess of 2%. Calculating the arithmetic mean of which first excluded, outliers, values, the authors considers that it is possible to show the arithmetic mean of the values that in comparison with the rest of the dataset values are the ones who in most cases characterize as a results of ratios. With outliers, the authors characterizes values that are unusually high or low relative to other values in a dataset. When calculating financial ratios, authors took into account the entity's financial indicator existence, which should be used to calculate the specific ratio. In cases where a specific financial ratio for the calculation were not available data from the financial statements, it was excluded from the total number of the calculated ratio and the number of analyzed ratios was reduced. The authors note that a separate calculation method was applied to ratio cash flow from operations / cash flow from investing activities. In Sabatnik's study, Commerksabidrubu Nadas plasma were pointed that in the denominator is used net investing cash flow, which actually shows the capital investments made by company during the reporting year. It should be noted that the internal financing potential is calculated and interpreted only if net cash flow of investing activities is negative, because capital by their nature is cash expense. Sabatnik's, 2008. Based on the literature source, the authors, calculating the financial results of the ratio was not taken into account those periods when investing cash flow has been positive. In order to more accurately show the capital expenditures made by company and their impact on the company's solvency. In order to compare the results provided by calculation of this ratio, which calculated taking into account the positive results of investment net cash flow, the authors didn't see significant change in trends of average results. If any differences were observed, they were observed in only one period, varying a specific number of years prior to the initiation of insolvency proceedings, when ratio tends to decrease. Based on the results of the study and text below, the authors demonstrated the most significant discoveries of each sector. In Table 3, authors showed a number of years prior to the insolvency proceedings and certain worsening trends of financial activities, when specific ratios pointed to the impending insolvency, according to the majority of the average calculation method. The authors concluded that the earlier ratio indicate the impending insolvency problems, the earlier possible to respond to the deteriorating financial situation to deal with them. To ratios that are not relevant for the assessment of solvency in any of the industries, the authors didn't state a certain number of years in table. For example, the ratio of net turnover/total assets, which ratio in any of the industries didn't show the ability to predict insolvency proceedings initiation in the future. In bold colored the number of years, when in specific industry all average calculation methods showed the same trends in the insolvency prediction. The authors conclude that in service industry of all analyze the average detection techniques to the trend gradually approaching the insolvency proceedings. In most cases, the results show from the second year before the initiation of insolvency proceedings. Comparing all 10 analyzed financial ratios. Among the companies in service industry, according to authors' opinion, above all, should be used ratios that point to the earliest period when it was shown tendencies to approach the insolvency proceedings, total liabilities/total assets, profit before interest expenses and taxes/interest expenses, profit before taxes/current liabilities. According to authors, important ratios is those which showed tendencies approaching insolvency by all average calculation methods, for example, current assets/current liabilities case. Most of the ratios based on the cash flow statement for the service industry, to the trends gradually financial situation grow worse, points from the second year before the initiation of insolvency proceedings. Such trends cash flow ratios showed only in service industry, which the authors explains with the high working capital movement of companies in this industry. Only ratio, cash flow from operations/cash flow from investing activities, pointed that after 3 of average calculation methods this ratio indicates the approaching insolvency in the third year before the actual process of initiation. Consequently, in the services industry in anticipation of solvency, according to the authors, should take into account all 5 on the cash flow statement-based financial ratios. The authors conclude that in service industry financial statements can be analyzed using both traditional financial analysis ratios and ratios based on the cash flow statement. Among production industry companies, the majority of the average calculation methods in solvency approaching more showed ratios, which forecasts for insolvency proceedings initiation showed from the third year before the actual insolvency proceedings initiation. Production industry ratio results did not show such a large number of the ratios that at the same time can predict the impending insolvency as service sector companies. The largest number of average calculation methods at the same time pointed to the impending insolvency only in current assets/current liabilities case. Production industry companies in insolvency prediction, according to the authors, above all should use ratios profit before interest expenses and taxes/interest expenses and current assets/current liabilities, because they first was able to point to an approaching insolvency. Comparing current assets/current liabilities results in production and service industries, it can be concluded that ratio shows similar trends in both industries. In both industries, the ratio the lowest and the sharpest reduction shows in the last year before the onset of insolvency proceedings, and this ratio decreases from the third year prior to the initiation of insolvency proceedings. Comparing traditional and on cash flow statement-based ratios results of companies in production service, the authors conclude that stronger forecasts of insolvency oncoming eventuality showed traditional financial analysis ratios. 2 of the ratios, which are based on cash flow from operations/current liabilities, and cash flow from operations/total liabilities, according to authors, is significant for insolvency prediction. However, the results show a less expressed trends as ratios, current assets/current liabilities, and total liabilities/total assets. Just as in service industry companies, also in trade industry in most cases, the average calculation methods for insolvency oncoming trends showed from the second year before the actual initiation. Trade industry companies, according to the authors, should be using ratios which results trends to approaching insolvency process indicates at least 3 years prior to its actual occurrence. Profit before taxes/current liabilities. Cash flow from operations/current liabilities. Cash flow from operations/total liabilities. Profit before interest expenses and taxes/interest expenses, and, according to authors, to these ratio results should pay attention at least 2 periods in length. The authors notes that in the trade industry company case, a ratio which based on cash flow statement is important, because from total proposed ratios 2 are used on the cash flow statement data and comparing the traditional and on the cash flow statement-based ratios, it can be seen that the role of insolvency forecasting is similar. Among companies that works in transportation industry ratios results tendencies to approach the insolvency proceedings, in most cases indicated in the 4th year before the initiation of insolvency proceedings, for example, ratios as current assets/current liabilities and cash flow from operations/current liabilities, because they earliest showed the ability to predict the approaching insolvency proceedings. Also, in the second year before the initiation of insolvency proceedings, there were several ratios, whose the results pointed to the insolvency proceedings approach, for example, ratios as profit before interest expenses and taxes/interest expenses, profit before taxes/current liabilities, cash flow from operations/total liabilities, profit before interest expenses and taxes/interest expenses. Significant results, according to the authors, showed the ratio total liabilities/total assets, the results of which should be assessed for several years. Comparing traditional financial ratio analysis results by a ratio which calculation is based on the cash flow statement, the authors conclude that in transport industry to insolvency proceedings showed both traditional financial analysis ratios and cash flow statement ratios, thus showing the importance of the insolvency assessment. The differences between the different ratios in industries the authors explain with the specific characteristics of each industry of the business and net turnover modeling point of view. In Table 4, using the data in Table 3, the authors showed each industry 3 main ratios that, in authors' opinion, should be taken into account in insolvency prediction. Table 4 shows ratios were displayed with a ranking help, where 1 represents the most significant financial analysis ratio, 2, the second most important, but 3 represents the third most important financial ratio in solvency assessment analysis. Ranks to certain ratios were given firstly, after how early these ratios point to an insolvency problem increase, and, secondly, after how much of the average calculation methods points to that. In service industry companies, authors points to the ratio total liabilities/total assets importance of assessing solvency, because ratio the earliest and after a series of average calculation methods referred to the ability to predict the approaching insolvency problems. In production industry, the most important ratio, according to the authors, profit before interest expenses and taxes/interest expenses, but in trade industry, profit before taxes/current liabilities. In transport industry, according to the authors, it is difficult to distinguish the most significant ratio because 2 ratios, after criteria set by the authors for determining significance, shows similar signs for example ratios as current assets/current liabilities and cash flow from operations/current liabilities. Thereby the results of these 2 ratios in the transport industry by the assessing the solvency level of the company should take particular account. 3. Conclusions, proposals, recommendations. In accordance with the goals of this paper, the authors investigated the indicators and ratios for the solvency assessment, analyzed the data of 13 insolvent enterprises of the Republic of Latvia in service industry, 18 insolvent enterprises of the Republic of Latvia in production industry, 12 insolvent enterprises of the Republic of Latvia in trade industry, and 7 insolvent enterprises of the Republic of Latvia in transport industry, and, by comparing the calculated ratios, have come to these conclusions. 1. Three main financial analysis ratios in service industry were total liabilities/total assets, the most important ratio, and which from the fifth year before the insolvency proceedings pointed to the insolvency problems. Profit before tax/current liabilities, the second most usable ratio in solvency evaluation, and profit before interest and taxes/interest expenses, the third most important ratio in solvency evaluation. 2. In service industry 2 years before the insolvency proceedings showed all in the study analyzed ratios that were based on cash flow statement data. 3. Three main financial analysis ratios in production industry for insolvency predicityn were profit before interest expenses and taxes/interest expenses, current assets/current liabilities, and total liabilities/total assets. In production industry for insolvency prediction, it is possible to use ratios that were based also on cash flow statement, cash flow from operations/current liabilities, and cash flow from operations/total liabilities, which results showed significant tendencies already 3 years before the insolvency proceedings. 4. Among three main financial analysis ratios in trade industry for insolvency predicityn were profit before taxes/current liabilities. That is the most important ratio in the 3 years prior to the initiation of insolvency proceedings referred to the insolvency problems, cash flow from operations/total liabilities, and cash flow from operations/current liabilities. 5. Among three main financial analysis ratios in transport industry for insolvency predicityn were current assets/current liabilities and cash flow from operations/current liabilities as the most important ratios, which results already 4 years prior to the initiation of insolvency proceedings referred to the insolvency problems after all the average calculation methods and total liabilities/total assets as the third most important ratio for solvency evaluation. 6. Comparing the 4 analyzed industries, the earliest insolvency predict ratio, total liabilities/total assets, because in service and transport industries this ratio showed to insolvency proceedings initiation already from 5th year, in production industry from 3rd year, but in trade industry from 2nd year before insolvency proceedings. 7. Comparing all industries, the ratio that the worst predicted to insolvency was net turnover/total assets, because none of the industry's contribution of this ratio in insolvency forecasting was not observed. 8. Using 50 insolvent companies in Republic of Latvia data, which calculated in 4 industries, and can be concluded that more important insolvency signs points traditional financial analysis ratios, while ratios based on cash flow statement its role in the insolvency evaluation shows only in the trade and transport company analysis. By assessing the results of the study, the authors believe that it has both theoretical and practical value. Depending on the industry, both traditional and on cash flow statement-based ratio calculations is necessary to use and should be assessed together. In order to assess possible insolvency problems in future, the authors recommends to use ratios that were pointed out in conclusions. The authors also believe that studies in insolvency evaluation with traditional and on cash flow-based ratios should be continued, analyzing a larger amount of insolvent companies' data. Here is a detailed summary of Revamping the Cash Flow Statement by B. W. Stein and W. D. Hammond. 1. Purpose of the article. The article argues that the existing cash flow statement format prescribed by AC 118 and IS 7 contains ambiguities and classification problems that reduce comparability, clarity, and usefulness. The authors propose a revised cash flow statement format that better explains how a company generates and uses cash. The central idea is to reorganize the statement around cash generated internally, mandatory cash utilization, maintenance versus expansion of the resource base, discretionary use of cash, cash generated externally. The goal is to enhance understandability for lay users while improving analytical usefulness for sophisticated users and investors. 2. Problems with the current cash flow statement. The authors identify several deficiencies in the traditional operating, investing, and financing classification model. 2.1 Ambiguity in definitions. The definitions of operating, investing, and financing activities are unclear and inconsistently applied. This impairs comparability between companies. Interest and dividends create particular confusion because standards allow alternative classifications. For example, interest received may be classified as operating or investing. Interest paid may be classified as operating or financing. Dividends received may be operating or investing. Dividends paid may be operating or financing. These options reduce comparability and introduce inconsistency. 2.2 Inclusion of non-cash transactions. Some companies improperly include non-cash transactions in cash flow statements, reducing reliability. 2.3 Disclosure deficiencies. Companies often fail to disclose required information, especially related to discontinued operations. This weakens users' ability to forecast future cash flows. 3. Conceptual shift proposed by the authors. Instead of focusing on operating, investing, and financing categories, the authors suggest that the statement should explain how the enterprise generates cash from its existing resource base, how that cash is consumed, how much must be reinvested to maintain operations, how much is available for discretionary purposes, whether external funding is required. They describe the firm as a cash-generating machine, and the statement should clearly explain that mechanism. 4. Proposed structure of the improved format. The revised format is illustrated using Transnet's 2003 financial statements. The traditional AC-118 format appears on page 12, while the proposed format appears on page 13. The key structural changes are as follows. For point 1, cash generated internally. This includes cash generated actively from operations, interest received, dividends received. This subtotal shows the total cash produced by the existing resource base. For point 2, mandatory cash utilization. This section deducts mandatory payments such as interest paid, taxation, compulsory loan repayments. It then deducts cash required to maintain the existing resource base, including replacement of property, plant, and equipment, replacement of intangible assets, sale or replacement of subsidiaries. This introduces a free cash flow concept directly into the statement. The crucial subtotal here is the residue or deficit of cash generated internally before discretionary use. This figure shows whether the company generated enough cash to sustain itself without relying on growth, dividends, or external financing. For point 3, discretionary utilization of cash. After maintenance needs are satisfied, the remaining cash can be used for dividends paid, secondary tax on companies, voluntary loan repayments, share repurchases, expansion investments. The authors stress the importance of separating maintenance expenditure from expansion expenditure. This distinction is critical for forecasting sustainable future cash flows. For point 4, cash generated externally. If internal cash is insufficient, external funding explains the deficit. This includes long-term borrowings, short-term loans, share issues, bank overdrafts. In the proposed format, bank overdrafts are treated as external financing rather than as part of cash equivalents. 5. Key conceptual improvements. 5.1 Separation of maintenance and expansion. The authors argue that replacing existing assets to maintain production capacity must be distinguished from expansion investment. Maintenance spending sustains existing cash-generating capacity. Expansion spending aims to grow it. Without this distinction, users cannot properly assess sustainable free cash flow. 5.2 Free cash flow integration. By deducting maintenance expenditure from internally generated cash, the format incorporates a free cash flow approach directly into the statement. This helps identify whether a company can sustain operations without external financing. 5.3 Improved treatment of taxation. Normal tax is included in mandatory utilization. Secondary tax on companies is grouped with dividends since it is directly related to dividend policy. 5.4 Clarification of cash and cash equivalents. The article critiques ambiguity in defining cash equivalents. Short-term treasury instruments should be classified based on whether they are used for short-term cash management rather than investment purposes. Bank overdrafts should be classified as external financing when they represent ongoing borrowing rather than temporary liquidity management. 6. Multi-period reporting recommendation. The authors strongly recommend multi-year disclosure, suggesting at least 5 years of historical data. Alternatively, 5-year or 10-year cumulative cash flow statements. They argue that 1-year data is insufficient to assess sustainability, asset replacement cycles, or cash flow smoothing. Multi-period data reduces manipulation concerns and improves predictive analysis. 7. Additional disclosure recommendations. The authors support enhanced disclosure of key management assumptions, investment policy, dividend policy, financing policy, market conditions, and economic assumptions. Such disclosures improve relevance and transparency, but should remain supplementary rather than embedded within the core statement. 8. Comparison of traditional versus proposed format. Using Transat as an example. The traditional format separates operating, investing, and financing cash flows, but the logic behind these categories is not always clear. The proposed format systematically explains total internal cash generation, mandatory payments, maintenance requirements, discretionary uses, external financing required. This provides a clearer explanation of whether the firm can sustain itself from internal cash alone. In the example year 2003, Transat generated insufficient internal cash to cover mandatory and maintenance obligations, suggesting that dividend payments may not have been financially sustainable. 9. Conclusion. The article concludes that the current IS 7/AC 118 cash flow format suffers from definitional ambiguity and inconsistent classification. The proposed model improves objectivity, logical flow, understandability for lay users, analytical usefulness for investors and analysts. By focusing on internal cash generation, mandatory obligations, maintenance of the resource base, discretionary utilization, and external financing, the revised format better explains the cash-generating mechanism of a company. The separation between maintenance and expansion expenditure, combined with multi-year disclosure, significantly enhances the ability to forecast future cash flows and assess financial sustainability. Analyzing financial statements is a fundamental practice for understanding a company's financial position, operational efficiency, and long-term viability. By carefully examining financial data, businesses and investors can make informed decisions that drive profitability, ensure liquidity, and manage risk effectively. The insights gained from financial analysis support strategic planning, resource allocation, and performance evaluation, allowing organizations to adapt to changing market conditions and maintain a competitive edge. A well-rounded financial assessment not only enhances transparency and accountability, but also fosters sustainable growth by identifying opportunities for improvement. In a dynamic business environment, the ability to interpret financial statements remains an essential skill for leaders, investors, and decision-makers seeking to navigate complexities and achieve long-term success. Financial decision-making is a critical aspect of business strategy that involves evaluating, planning, and executing choices that impact an organization's financial health and long-term sustainability. It encompasses investment decisions, capital structure optimization, and risk management to ensure efficient resource allocation and value creation. By analyzing financial statements, market trends, and economic conditions, decision-makers can assess potential risks and rewards, enabling them to make informed choices that align with business objectives. The integration of financial principles with strategic management allows businesses to navigate uncertainties, optimize cash flow, and enhance profitability. As financial landscapes become increasingly complex, the ability to leverage data-driven insights and innovative financial tools becomes essential in driving sustainable growth and competitive advantage. Here is a detailed summary of an investigation of the usage of capital budgeting techniques by small and medium enterprises by Alice et al., 2021. 1. Purpose of the study. The study examines the extent to which small and medium enterprises, SMEs, in Sri Lanka use capital budgeting techniques. The effect of non-financial factors on the choice of capital budgeting techniques. The research focuses on SMEs operating in the Colombo district of Sri Lanka and addresses a significant research gap in the Sri Lankan SME context. The study is motivated by the importance of SMEs to the Sri Lankan economy, where they represent more than 75% of enterprises, provide approximately 45% of employment, contribute more than 50% of GDP. Despite their importance, SME failure rates are high, partly due to weak financial decision-making practices. 2. Research objectives and hypotheses. The study has two primary objectives: to identify the most commonly used capital budgeting techniques among SMEs, to determine whether non-financial factors influence the choice of technique. The four non-financial factors examined are: level of education of the decision-maker, years of experience of the decision-maker, years of operation of the SME, form of ownership, local or foreign. The study tests four hypotheses linking these factors to the sophistication of capital budgeting methods used. 3. Methodology. 3.1 Data collection. The study was conducted in 3 municipal divisions in Colombo: Hamagama, Kalanawa, Henwela. A stratified random sampling method was used. Population: 553 SMEs. Questionnaires distributed: 190. Valid responses: 60. Response rate: 31%. Data were collected through questionnaires and personal interviews. 3.2 Analytical tools. The study used 3 main analytical techniques: descriptive analysis to measure the usage of capital budgeting techniques, chi-square test of independence to test associations between variables, multinomial logistic regression, MLR, to estimate the probability of choosing specific capital budgeting techniques. Additionally, word cloud analysis was used to analyze qualitative responses regarding reasons for non-usage of capital budgeting techniques. 4. Key findings. 4.1 Most common capital budgeting techniques. According to Table 1 on page 1001, the usage distribution is: payback period, PBP 55%. Net present value, NPV 37%. Internal rate of return, IRR 12%. Accounting rate of return, ARR 0%. The payback period is the dominant technique used by SMEs. This finding aligns with previous international research showing SMEs prefer simple and less sophisticated techniques. The primary reasons for PBP preference include: simplicity, ease of understanding, no need to estimate a discount rate. 4.2 Chi-square results. The chi-square test shows significant associations between the choice of technique and form of ownership, company age, years of business experience of the decision-maker. However, educational qualification of the decision-maker was not significantly related to the choice of capital budgeting technique. This contradicts some previous international studies that found education level to be significant. 4.3 Multinomial logistic regression, MLR, results. The MLR results provide deeper insight into probability effects. 1. Foreign ownership. Foreign-owned SMEs are 59.68% more likely to use MPV, 20.7% less likely to use IRR, 38.97% less likely to use PBP. Foreign firms are therefore more inclined to use sophisticated discounted cash flow techniques such as MPEV. 2. Company age. SMEs operating for 11 to 15 years are 67.18% more likely to use MPEV, 58.21% less likely to use PBP. Firms in this age bracket show higher sophistication in capital budgeting practices. 3. Decision-maker experience. Decision-makers with less than 10 years of experience are 29.61% less likely to use MPEV, 34.34% more likely to use PBP. Less experienced decision-makers tend to rely on simpler techniques. 4. Education level. Education level was not statistically significant in determining technique choice. 5. Reasons for non-usage of capital budgeting techniques. The study used word cloud analysis to evaluate qualitative responses. The word cloud, page 1003, highlights 3 dominant barriers: cost, time, knowledge. These are the primary reasons SMEs avoid or abandon formal capital budgeting techniques. SMEs perceive capital budgeting as time-consuming, expensive to implement, requiring specialized knowledge they may lack. 6. Policy implications. The findings suggest that government agencies should promote financial literacy and capital budgeting training among SME decision-makers. Policies should target less experienced SME owners. Programs should address cost and knowledge barriers. The study recommends developing structured training and awareness programs to enhance the adoption of sophisticated capital budgeting techniques. 7. Limitations and future research. Limitations include small sample size, data limited to the Colombo district, lack of a comprehensive SME database. Future research should expand to rural regions of Sri Lanka, conduct provincial-level comparisons, compare urban and rural capital budgeting practices. 8. Overall conclusion. The study concludes that payback period remains the dominant capital budgeting technique among Sri Lankan SMEs. Ownership structure, firm age, and decision-maker experience significantly influence technique choice. Foreign and more established SMEs are more likely to use NPV. Education level does not significantly affect technique selection. Cost, time, and lack of knowledge are key barriers to adoption. The study fills an important empirical gap in Sri Lankan SME research and provides valuable insights for policymakers and SME development programs. Risk, no matter how slight, is an element of virtually every capital budgeting decision. Numerous decision procedures have been proposed in the literature and reported in surveys of practitioners for dealing with risk. However, the relative performance of these decision procedures in attaining the decision-maker's financial objective while also dealing with risk effectively in long sequences of capital rationing decisions is not clear. There is a need, therefore, for studies to evaluate the relative, long-term performance of common capital budgeting decision procedures used in practice and proposed in the literature for dealing with risk. This paper reports the results of one such study. 1. The study used Monte Carlo computer simulation of long sequences of capital rationing decisions to evaluate the relative effects on the capital growth rate and risk of ruin of simulated firms, each using one of 6 capital budgeting decision procedures for dealing with risk. The 6 decision procedures were: 1. RNPV/R sub A, rank on net present value NPV, with risk-adjusted discount rate R sub A. 2. RR/R sub A, rank on internal rate of return, IRR, with risk-adjusted discount rate R sub A. 3. RPP/N sub A, rank on payback period with risk-adjusted payback period N sub A. 4. RNPV/N sub A, rank on NPV with risk-free discount rate R as the primary criterion, and payback period with risk-adjusted payback period N sub A as the secondary criterion. 5. RNPV/beta, rank on expected value, NPV with risk-free discount rate R as the primary criterion, and profitability risk restriction PR, NPV 0, equals beta, as the secondary criterion, and 6. Random selection. The first 5 of these decision procedures use common measures of worth, IRR, NPV, or payback period, as the measure of economic merit, and similarly, they also exhibit some common approaches for dealing with risk. 4 of them, RRR/R sub A, RNPV/R sub A, RPP/N sub A, and RNPV/N sub A, assess risk subjectively by using either a risk-adjusted discount rate or a risk-adjusted cutoff payback period for dealing with risky investment opportunities, and the 5th, RNPAV/beta, uses an opportunity's NPV probability distribution to assess an opportunity's risk more objectively. The 6th decision procedure, random selection, was included in the study as a benchmark. Also common to the first 5 decision procedures is that it is possible for a decision maker to err in assessment of an opportunity's risk. That is, in the case of the subjective risk assessment techniques in the first 4 decision procedures, a decision maker's judgment could be incorrect, or in the case of the more objective risk assessment technique in the 5th decision procedure, a decision maker's estimation of the governing probability distributions and related parameters could be inaccurate. Thus, a decision maker may misperceive an opportunity as risky and perhaps reach a decision that is different than would have been reached had the decision maker perceived the opportunity's risk correctly. Similarly, a decision maker could misperceive an opportunity as not risky and fail to account for risk at all. Misperception in risk assessment was also one of the issues studied. Therefore, this study sought, partly, to obtain insights into the relative performance of these particular decision procedures, but mostly, to gain a better understanding of the effectiveness of the philosophies underlying these decision procedures for the treatment of risk in long sequences of capital rationing decisions involving risk. Related research has yielded valuable insights for decision procedures that do not consider risk: 15, 17, 20, 21, 22, 24, 25, 35. This study serves to add that body of knowledge as further information about and understanding of the performance of different approaches for dealing with risk in capital budgeting decision-making. In the remainder of this paper, some of the fundamental philosophies and principal decision techniques for dealing with risk that are used in practice and discussed in the literature are described first. 5 capital budgeting decision procedures that reflect these philosophies and techniques are then presented. The 6th decision procedure presented is random selection. The essential elements of the simulation model used and the model's measures of performance are discussed subsequently, and the results of 5 simulation experiments are then presented. Accounting for risk. Capital budgeting practices have been documented in various surveys 4, 5, 11, 26, 29, 32, and summarized collectively in other publications 6, 27. With respect to the perception of risk in practice, Ganani 6 observed, risk in the capital budgeting context includes financial risk associated with leverage, business risk associated with the type of activity engaged in, risk of technological change, obsolescence, and risk due to errors in estimation of the parameters entering into analysis. Because of the reward system in industry, executives in general are risk-averse, and they favor measures that can be translated into explicitly measurable goals. Risk is perceived by the majority of them as either the probability of not achieving a given target return or the degree of downside. When proposed projects involve a small portion of the budget, risk is merely the prospect of not meeting the target. However, for large investment proposals, a possibility of insolvency exists, and hence the emphasis is on downside risk. Risk assessment in practice is predominantly subjective. Shaw et al. 29 found that 4% of firms surveyed gave no consideration to risk, 60% assessed risk subjectively, and 36% used some quantitative analysis, mostly sensitivity analysis or Monte Carlo computer simulation of an opportunity's cash flows. Other methods reported to account for risk were to adjust, increase the discount rate, 19%, decrease the maximum acceptable payback period, 14%, use certainty equivalence, 3%, and employ utility theory, 3%. Gitman and Forrester, 5, found that 43% of the firms they surveyed increased the discount rate, 26% used expected values of cash flows, and 13% decreased the maximum acceptable payback period. Kim and Faragher, 11, reported that payback period was used as a secondary measure by 39% of their 200 respondents from large industrial corporations. Pike, 26, found in 100 large industrial firms in the United Kingdom that naive appraisal methods and spreadsheet techniques such as payback period, shortening the maximum acceptable payback period, increasing the discount rate for risk, and sensitivity analysis still enjoy wide support. The approaches suggested in the literature for dealing with risk in capital budgeting decision-making range from very simple to extremely complex. Some authors suggest simple adjustments to the measure of worth values or the decision rules. 30. Others suggest developing probability distributions of measures of worth or cash flows for risky opportunities. 8. 9. While others employ mathematical programming techniques, such as stochastic linear programming under uncertainty, chance-constrained programming, and goal programming. 2. 10. 28. Despite some theoretical deficiencies and the existence of more sophisticated approaches, the simpler approaches are still the ones commonly used in practice to deal with risk. Thus, this study investigated 5 decision procedures that reflect the fundamental philosophies and techniques used in practice for dealing with risk in capital budgeting decision-making. They use common measures of economic, worth, and well-known mechanisms to account for risk. A 6th random selection served as a benchmark. We precede the description of these decision procedures with some terms and definitions. Terminology. Risk results from uncertainty. It is perhaps for this reason that the terms risk and uncertainty are often used interchangeably. Indeed, variance, which is a measure of dispersion, uncertainty, is commonly used as a measure of risk. However, variance is not a measure of risk and, in this paper, the terms uncertainty and risk will not be used interchangeably. Uncertainty exists when the outcome of a random event is not known a priori, regardless of whether the probability distribution that governs it is known or not. Risk is the probability of an undesirable outcome, a definition which is consistent with its use in Industry 6 and in common language 33. A firm can thus be exposed to any number of risks, each defined by its undesirable outcome. For example, the term risk of economic loss could be used to describe the probability of not achieving a specified target return, and the risk of ruin could be used to describe the probability of insolvency. Thus, as used in this paper, uncertainty per se conveys nothing about the undesirability or desirability of the possible outcomes of a random event, whereas risk does. Ranking decision procedures are common in practice. A ranking decision procedure can be described formally as follows. A schedule of opportunities is ranked in decreasing order of attractiveness according to the value of a specified measure of worth. Opportunities whose measure of worth value does not meet an acceptable value according to a specified decision rule are rejected. The remaining opportunities are accepted one at a time, beginning from the top of the list and continuing down the list until either the budget or the list is exhausted. Among the weaknesses of ranking decision procedures are that they do not necessarily consider increments of investment, i.e., an incremental analysis, nor do they necessarily optimize the investment of the budget in the sense of maximizing future wealth. Both of these weaknesses would be avoided with a mathematical programming decision procedure using a measure of worth based on the financial objective of maximizing the decision maker's future wealth. A risk assessment decision procedure is used to evaluate an opportunity's risk according to a specified measure of risk. One approach would be to classify opportunities into risk classes according to the subjective judgment of the decision maker and then subject each opportunity to a more or less stringent hurdle of economic acceptability according to its risk class. 16. A more sophisticated decision procedure would evaluate the risk of each opportunity according to a probabilistic measure and reject those whose risk, probability, exceeds a specified acceptable probability. A major issue in either case is the importance of assessing the risk of an opportunity accurately. Of the 6 decision procedures studied, 5 can be characterized as ranking risk assessment decision procedures, 4 of which use subjective risk assessment techniques and 1 uses a more objective risk assessment technique. The 6th random selection, of course, uses neither a measure of economic merit nor risk assessment. In this paper, a subjective assessment of an opportunity's risk is one in which the decision maker uses deterministic measures that are adjusted, as deemed appropriate, based on the decision maker's intuition, judgment, experience, etc. Sensitivity analysis is an example of a widely used subjective risk assessment technique. An objective assessment of an opportunity's risk is one in which the decision maker uses probabilistic measures based on estimates of the appropriate governing probability distributions and related parameters, e.g., means, variances. This is not to imply that one approach is necessarily better or preferred to the other, but rather to note their differences. One relies principally on a decision-maker's intuition and judgment about an opportunity's uncertainty and risk in the absence of objective measures of that uncertainty and risk, and the other does not. Presumably, the reason decision-makers perform risk assessments, whether subjective or objective, is to assess how the acceptance of an individual opportunity may affect the firm's long-term capital growth rate and risk of ruin, i.e., its long-term viability. The decision procedures studied address the risk of economic loss of an individual opportunity failing to meet some desired level of profitability and not, at least not directly, how the opportunity individually may affect the risk of ruin of the firm. They are representative of the more common techniques used in practice, in which a decision-maker's consideration of an opportunity's potential effect on the firm's risk of ruin is based primarily on an evaluation of its risk of loss. The 6 decision procedures studied are as follows. Rank on NPV with risk-adjusted discount rate, RNPV/R sub A. For RNPV/R sub A, opportunities are ranked according to their expected value, NPV, where each opportunity's NPV is computed using a specified risk-adjusted discount rate, R sub A, for the risk class A equals 1, 2, 3, to which an opportunity is judged to belong. Opportunities judged not risky are classified as risk-free, and their NPVs are computed using a specified risk-free discount rate, R. It is assumed that R sub A equals R for all risk classes. The decision rule associated with the measure of worth NPV is that opportunities with a positive valued NPV are considered acceptable. The philosophy for dealing with risk underlying RNPV/R sub A is that by using expected values of net cash flows to calculate an opportunity's NPV, some of the variability in the net cash flows can be captured. Since probability distributions for the net cash flows are typically not determined for this decision procedure, the net cash flow values can be described as the decision-maker's perception, estimation of the expected values. Opportunities deemed risky have their attractiveness reduced relative to other opportunities deemed safer by adding a so-called risk premium to the discount rate. It should be noted, however, that the use of a higher discount rate can affect not only the ranking of risky opportunities relative to other safer opportunities, but also the ranking among risky opportunities. Rank on IRR with risk-adjusted discount rate, RIRR/R sub A. For RIRR/R sub A, opportunities are ranked according to their IRR. Similar to RNPV/R sub A, expected value cash flows, or the decision-maker's perception of them, are used to compute the IRR for each opportunity, and a risk-adjusted discount rate is then used to evaluate an opportunity's acceptability according to the risk class to which it was judged to belong. Opportunities deemed not risky are judged using the risk-free discount rate, R. The decision rule associated with the measure of worth IRR is that an investment opportunity is considered acceptable if its IRR exceeds the specified cutoff discount rate. A more complete discussion of the IRR, its proper use as a measure of worth, and the problems of multiple internal rates of return and mixed investment borrowings can be found in 1319. This paper does not delve into these issues. The philosophy for dealing with risk underlying RR/R sub A is similar to RNPV/R sub A. However, the use of a higher discount rate for risky opportunities does not affect the ranking of any opportunity relative to the other opportunities, risk or not, and possibly affects only an opportunity's acceptability. Further, while ranking on IRR generally violates the principle of decisions based on differences, studies have shown nonetheless that it performs quite well, 15, 20, 25. Rank on payback period with risk-adjusted cutoff payback period, RPP/N sub A. For ROPP/N sub A, opportunities are ranked according to their payback period. The measure of worth, payback period, is the smallest number of periods in which an investment opportunity recovers its investment together with interest at a specified rate. It is computed using either the risk-free discount rate, R, or a discount rate equal to 0. The latter is often called undiscounted payback period. A risk-adjusted payback period, N sub A, is specified for each risk class of opportunities. The decision rule associated with the measure of worth payback period is that an opportunity is considered acceptable if its payback period is less than N sub A. We will refer to N sub A hereafter as the cutoff payback period. The philosophy for dealing with risk underlying RPP/N sub A is that recovering one's investment sooner lessens the exposure to risk of the capital invested. By ignoring distant cash flows, it is advocated that RPP/N sub A recognizes that risk, actually uncertainty, increases with time. 34. It is not clear, however, that recovering the investment sooner reduces the risk since the returns are reinvested in other opportunities and thus capital is, in essence, always at risk. In reality, RPP/N sub A neither addresses uncertainty nor risk, but there are those who nonetheless extol its virtues in dealing with uncertainty and risk. On the other hand, RPP/N sub A does tend to select opportunities that return funds sooner, thus making incremental funds available for further investment. However, its proponents have presented no evidence that receiving funds sooner is better for the firm. The decision strategy of choosing opportunities with a short-term capital recovery was investigated in one of the experiments in this study. Since payback period measures the time for recovery of an investment and not profitability per se, its contribution toward maximizing a firm's wealth is doubtful. Nonetheless, it should do as well as or better than a random selection decision procedure that uses no measure of worth at all. Rank on NPV with secondary measure payback period, RNPV/N sub A. Payback period also enjoys wide use as a secondary measure 11.26. RNPV/N sub A used NPV as the primary measure of economic merit and payback period as a secondary measure of deal with risk. Specifically, the decision procedure RNPV, computed with a risk-free discount rate, is used to identify an acceptable set of opportunities. From this set, opportunities are then selected that also meet a specified cutoff payback period, N sub A. The underlying philosophy is to use NPV to identify the economically meritorious opportunities and then to screen out those deemed too risky as evidenced by their longer payback periods. Rank on NPV with risk restriction on NPV, RNPV/beta. RNPV/beta first ranks opportunities according to their expected value NPV, using a risk-free discount rate, and those with non-positive NPVs are discarded. It then screens out additional opportunities that do not meet the risk restriction of the probability of an undesirable NPV. A typical value for the upper limit on undesirable NPVs could be NPV equals 0. This was the value used in our experiments. Thus, the risk restriction was PR NPV 0 equals beta. The underlying philosophy for this decision procedure is that by selecting opportunities that have only a small risk of loss of not meeting a target return 6, the risk of ruin to the firm can be reduced. More elaborate risk restrictions could also be formulated for the distributions that describe the net cash flows of the individual opportunities. In that case, only opportunities with acceptably low probabilities of having undesirable net cash flows would be selected. Risk restrictions on the net cash flows would represent a more restrictive approach for dealing with risk. Indeed, risk restrictions on net cash flows can be shown in certain circumstances to be a social case of a risk restrictions on NPV. Regardless, adding either or both of these probability restrictions to RNPV acts only as a screen and does N alter the relative ranking of the opportunities. Random selection. For random selection, opportunities are selected randomly without regard to either their profitability of risk. It requires no estimation of any parameters except for the opportunity's first costs. The decision maker is restricted from knowingly selecting opportunities that exceed the budget at the decision time. This decision procedure was included in his study as a benchmark by which to compare the more logical decision procedures described above. Logical decision procedures that use reliable information should perform better than random selection, but it is also expected that as errors in estimation of that information reduce its reliability, the performance of the logical decision procures would approach that of random selection 15, 20, 22. In cases of either extremely biased or misleading information, it is possible that some logical decision procedures could perform worse than random selection, as will be shown in the experiments performed. A methodology for evaluating decision procedures. Computer simulation in capital budgeting decision-making is not new. For investigations requiring results from long sequences of realistic capital budgeting decisions in a timely, economical, and scientific manner, the only practical avenue is Monte Carlo computer simulation. It allows studies under controlled conditions at an affordable cost and with the freedom to define fairly complicated situations. It, of course, poses its own problems such as appropriate model development, design of meaningful experiments, and defining measures of performance. Early uses studied capital budgeting under uncertainty involving complete information 7, 8, 31. Thewson and Oakford 23, 24 pioneered the use of computer simulation to investigate situations involving long sequences of capital rationing decisions under certainty and incomplete information. Subsequent researchers extended this approach to study a number of capital budgeting issues, leading to the development of a model known as DECSIM, a contraction of decision simulator 3, 17, 21, 25, 35. Risk was not considered in these studies since they either assumed certain cash flows or provided unlimited short-term credit to alleviate ruin. Lohman and Oakford, 15, extended DECSIM in their studies to examine capital budgeting debt policies and risk. The study reported here developed a model called DERSIM, a contraction for decisions under risk simulator, and it can be viewed as an extension of DECSIM. The following is a brief description of the methodology used to study the relative performance of capital budgeting decision procedures for dealing with risk. 1. It highlights the fundamental elements of DERSIM so as to facilitate understanding and interpretation of the results of the experiments. Simulating long sequences of decisions under risk. It is assumed a decision maker faces a long sequence of periodic capital rationing decisions involving uncertainty and incomplete information. Uncertainty in that the cash flows that describe long-term investment opportunities available at the decision time are uncertain, random variables, and incomplete information in that the decision maker knows only the opportunities available currently but does not know, but expects, opportunities to become available at subsequent decision times. The sequence of decisions is assumed to have begun long ago and, barring ruin, will continue into the indefinite future. This situation is most representative of an established firm that coordinates its capital rationing decisions with its annual budget review. Although this model is applicable more broadly, including such decision environments as personal portfolio management. At each decision time, the decision maker is presented with a budget and a schedule of long-term investment opportunities. The long-term investment opportunities represent mostly investments in the firm's business. Each long-term investment opportunity in the schedule presented is summarized by its net cash flows. The decision maker selects a subset of opportunities from the schedule according to the budget and a specified decision procedure. Long-term investment opportunities are either accepted or rejected in their entirety, and those selected cannot later be divested. Portions of the budget not invested in long-term investment opportunities, if any, are invested for one period in short-term investments, e.g., market investments, until the next decision time one period later. The budget available at a given decision time includes the returns to be received at that decision time from both long-term investments made previously as well as short-term investments, if any, made at the preceding decision time. In this study, borrowing was not allowed. Based on related research, 15, it was believed that the additional modeling complications to allow borrowing would not yield significantly different insights. The sequence of investment decisions continues until either a predetermined number of decisions is completed or the firm suffers ruin. The firm suffers ruin if the budget at the current decision time is negative. In reality, firms would likely seek either short-term or long-term debt, or both, or other financial resources to cover the shortage. 14. Since the decision procedures studied are intended to help a decision maker avoid such circumstances, a definition of ruin was chosen so as to observe how effectively these decision procedures avoided placing the decision maker in such financial straits. At the completion of the simulation of a sequence of decisions, the vector of budget amounts available for future periods and the risk, probability, of ruin were used to describe the results of the firm's decisions and the performance of the decision procedure used. Measures of performance. A number of measures of performance could be used to evaluate the results of sequences of capital rationing decisions, and each has its trade-offs: 1, 12, 17, 23. All of them, however, are based on output budget vectors. A budget, cash flow, vector, whose first value occurs one period after the last decision in the sequence, is comprised of the future returns from investments selected from decisions prior to and including the last decision in the sequence. This vector, in essence, is the future value of the firm that the decision maker seeks to maximize as a consequence of the sequence of decisions. Given identical input, two different simulation experiments could be compared in theory by comparing their output budget vectors. Such comparisons in practice would be difficult unless one budget vector dominated the other, 15, 20, 20. Consequently, a surrogate measure was used. For each simulation, an average input budget vector and an average output budget vector was computed. Using the input and output budget vectors from each replication of a sequence of decisions that did not result in ruin. These average budget vectors were then used to compute the average capital growth rate of the firm, GF, which was the of the cash flow series formed by using the average input budget vector as the investment and the average output budget vector as the return. Another output from the simulation is the risk of ruin of the firm, which can also be measured in many different ways. For this study, the risk of ruin of a firm, PF, was defined as the relative frequency, probability, with which replications of a sequence of decisions resulted in ruin on or before the specified termination time for the sequence. Thus, for each simulation of a long sequence of capital rationing decisions involving risk, two scalar measures of performance were obtained, GF, PF. Judgment is required in the trade-offs between values of GF and PF in comparing the results of simulation experiments. If GF is higher and PF lower for one simulated firm than another, then presumably one firm did better relative to the other. To know whether either or both firms did well overall, however, requires subjective assessment of the values of GF and PF. Quantifying these trade-offs in the experiments performed was not a major concern, since the intention of the study was not to prove the superiority of one decision procedure over another, but rather to observe their performance relative to one another under different situations. Generation of long-term investment opportunities. Applying a specified decision procedure to schedules of long-term investment opportunities, recording the selections, and accounting for the resulting cash flow consequences are relatively straightforward bookkeeping processes. However, the process to generate long-term investment opportunities is a more central and critical element of the simulation, and it needs to be described substantively. Very little has been published on the long-term investment opportunities generation process of firms except for Viafor's study involving several large firms, 32. Even here, however, the results were inconclusive due to incomplete and inaccurate company records. Thus, data about the long-term investment opportunities generation process of firms are largely unavailable and unknown. Nonetheless, it seems reasonable to view long-term investment opportunities as the product of a stable random generation process. One can envision two types of uncertainty associated with cash flows. One is uncertainty about cash flow outcomes given the governing probability distributions are estimated accurately, and the other is uncertainty about the estimates of the governing probability distributions. In an environment of certainty, the cash flow forecasts used to make decisions are identical to the cash flows to be realized if the opportunity is selected. Under uncertainty, the cash flows to be realized cannot be known a priori, whether the cash flow distributions are known accurately or not. If a decision maker estimates the cash flow distributions accurately, then both the expected value cash flows and risks can be calculated accurately. If the decision maker errs in estimating the distributions, then the expected values and risks calculated by the decision maker will likely be in error and possibly affect the decision. The errors in estimation will not, of course, affect the cash flows eventually realized if the opportunity is selected. Related studies have shown that as the error in estimation of cash flows increases, the long-term financial effectiveness of logical decision procedures approach that of random selection. 15, 21, 22. The decision procedures in those studies, however, did not include consideration of risk. Thus, this study focused on errors in risk assessment and its effects on the long-term survival of the firm. The generation of cash flows for each long-term investment opportunity and the effects of errors in risk assessment were modeled as follows. An expected value version of the net cash flows of a long-term investment opportunity would be generated from specified input distributions which allowed variation, randomness, in the first cost, life, cash flow pattern of the returns, and IRR. In the case where the decision maker used RNPV/beta, the probability of undesirable NPVs would be computed for each opportunity. When an opportunity was selected, another version of net cash flows was generated from the input distributions to represent the returns to be realized. The decision maker, of course, would learn about these values only over time as the returns were received and used to compose the budget at each decision time. Thus, the decision maker would make decisions based on the version representing the expected value net cash flows, and then receive over time the version representing the realized net cash flows from the opportunities selected. Generation of a long-term investment opportunity also involved generation of its inherent uncertainty and risk classification. In practice, long-term investment opportunities can be envisioned that span a broad range of uncertainty and risk from none, or virtually none, to extremely speculative. This study classified long-term investment opportunities into only two classes: less risky, henceforth referred to as safer, and more risky, henceforth referred to as risky. This classification permitted understanding without undue calculation. Nonetheless, it is important to remember that both classes involved uncertainty and risk, one less, the other more. The effects of errors in risk assessment were modeled as part of the global characteristics used to simulate the generation of long-term investment opportunities under capital rationing. These characteristics included the degree of capital rationing, the total cost of the opportunities relative to the budget, the distribution of IRRs of the long-term investment opportunities, and the relative riskiness of the long-term investment opportunities. These characteristics can be described in terms of a firm's investment opportunities function, as shown in Figure 1. Figure 1 omitted. It shows the fraction of the budget at each decision time, F, that could be invested in investment opportunities to grow at a given IRR or higher. The sloping portion of the curve represents long-term investment opportunities, and an infinite supply of short-term, market, investment opportunities were assumed available at an IRR of I. A concave investment opportunities function is more representative of practice, whereas we use the linear function shown to facilitate the calculations. 32. The shape of the investment opportunities function used here is irrelevant to the explanations of the results of our work. The value M is the IRR of the marginal long-term investment opportunity, where the last increment of investment in long-term investment opportunities with an IRR greater than or equal to M would absorb all of the budget. It also represents the rate at which the incremental funds released by the decision about the current schedule of investment opportunities would be reinvested in the future. 18. The expected value IRRs of long-term investment opportunities were generated by random sampling from the investment opportunities function shown. Both safer and risky long-term investment opportunities are represented in the investment opportunities function in Figure 1. The opportunities in each risk class can also be represented by two separate investment opportunities functions, one for safer opportunities and one for risky opportunities, as shown in Figure 2. Figure 2 omitted. Thus, Figure 1 is the combination of the two functions in Figure 2. In Figure 2, the risky investment opportunities function has been reversed to slope downward from right to left and superimposed over the safer investment opportunities function. Thus, if the fraction of the budget invested in safer long-term investment opportunities was, say, F sub S equals 0.50, then the fraction of the budget remaining available for investment in risky long-term investment opportunities would be F sub R equals 0.50. Of course, f sub s plus f sub r equals 1.0. Since an interest of this study was the effects on the firm's capital growth rate and risk of ruin due to a decision-maker's errors in risk assessment of individual opportunities, and not the manner by which a decision-maker makes such errors, the model reflects the effect on the decision-maker's selections and not necessarily the process by which such errors may occur in practice. Thus, the model reflected the notion that because of the decision-maker's errors in estimation of cash flows, cash flow distributions, or intuition, a decision-maker could misperceive a long-term investment opportunity's riskiness and either select it when it should have been rejected or vice versa. In fact, DIRSM can handle a wide range of misperceptions of risk. A decision-maker could be modeled who either correctly perceived the risks of all opportunities or misperceived all risky opportunities, thus they would be perceived as safer, or misperceived all safer opportunities, thus they would be perceived as risky, or misperceived all opportunities, thus safer would be perceived as risky, and vice versa, or misperceive some fraction of safer opportunities and some fraction of risky opportunities, thus some would be perceived correctly and others not. For RNPV slash R sub A, RRR slash R sub A, RPP slash N sub A, and RNPV slash N sub A, the effect of a misperception of a long-term investment opportunity's riskiness would be to subject the opportunity to a cutoff hurdle for the wrong risk class. For the risk class identified as safer, the cutoff hurdles were either the risk-free discount rate R, which was either the marginal growth rate M, or the short-term investment rate I, depending on the experiment, or an infinite cutoff payback period. In effect, the cutoff payback period was not restrictive and long-term investment opportunities judged safer were selected until either the budget or the schedule of opportunities was exhausted. For the risk class identified as risky, the hurdles were either a higher value of R or a lesser value of N sub A. For the decision procedure RNPV/beta, the effect of errors in risk assessment were modeled as follows. In applying the decision procedure RNPV/beta, the investment selection process was adjusted randomly according to the degree of error in risk assessment under study. For example, to study the effect of a decision maker who misperceives the risk of 50% of the risky long-term investment opportunities and none of the safer long-term investment opportunities generated at each decision time. Half of the risky long-term investment opportunities available at each decision time would be randomly marked-coded to have their risk misperceived. Thus, some otherwise unacceptable risky long-term investment opportunities with positive expected value NPVs might be selected. Budget permitting, some acceptable risky ones would be rejected. And still others with non-positive expected value NPVs would be rejected regardless of the misperceived risk. 5 simulation experiments. 5 simulation experiments were performed to observe the performance of 1. RRR/R sub A and RNPV/R sub A 2, RPP/N sub A 3, RNPV/N sub A 4, RNPV/beta and 5. The risk avoidance strategy of choosing opportunities which promise short-term capital recovery. In most experiments, errors in risk assessment were studied in addition to investigation of the effects of other parameters. 4 categories of errors in risk assessment were studied. 1. The risks of all long-term investment opportunities were perceived correctly. 2. The risks of all risky opportunities were misperceived, and thus all opportunities were perceived as safer long-term investment opportunities. 3. The risks of all safer long-term investment opportunities were misperceived, and thus all opportunities were perceived as risky. And 4. The risks of all long-term investment opportunities were misperceived and thus risky ones were perceived as safer and safer ones as risky. Misperceiving the risks of some fraction of the long-term investment opportunities was studied, and these experiments produced results that are bounded by the 4 cases above. Hence, these experiments are not presented. Each experiment involved 100 replications of at most a sequence of 15 decisions. Thus, the total number of decisions for each experiment could be no less than 100, which would occur if the entity suffered ruin after the first decision of each replication, and no more than 1,500, which would occur if the entity did not suffer ruin for any decision. A comparison and evaluation of specific data points produced by one decision procedure with the data points produced by another decision procedure proved difficult in some cases because the values of GF and PF required subjective judgment of the trade-offs between, typically, a higher GF or a lower PF, or there was not a one-to-one correspondence with some of the parameters that define the decision procedures compared. For example, there is no basis to equate values of R sub A and beta in the decision procedures RNPV/4 sub A and RNPV/beta, or one decision procedure sought to attain a financial objective different than the others, for example, RPP/R sub A. Nonetheless, some useful general comparisons could be made and insights gained. Experiment 1. The performance of RRR/R sub A and RNPV/R sub A. The results of two sets of simulations involving RRR/R sub A and RNPV/R sub A are shown in figures 3a and b. The risk-free discount rate was the short-term investment interest rate R equals I equals 0.10, and the risk-adjusted discount rate was varied between 0.10 and 0.40. The results for both decision procedures were very similar and, therefore, the results for both will be discussed simultaneously. The results are also consistent with related research 15, 20, 24, 25. In general, the decision procedures performed about equally well and were more insensitive for values of R sub A less than M than for values of R sub A greater than M. Except for the higher risk-adjusted discount rates, the capital growth rates using RR/R sub A and RNPV/R sub A were significantly higher than the firm using random selection, but their risks of ruin were nearly equal to that of random selection. In general, RRR/R sub A produced slightly higher capital growth rates than RNPV/R sub A, but it also produced somewhat higher risks of ruin. When the decision-maker misperceived risky long-term investment opportunities as safer, thus treating all long-term investment opportunities as safer, all safer in figures 3a and b. The values of GF and PF plot as horizontal lines displaying their independence of R sub A. The capital growth rates were at or near the maximum value, but the risks of ruin were also nearly equal to that of random selection, which is to be expected. In the opposite situation where the decision-maker misperceived the safer long-term investment opportunities and treated every long-term investment opportunity as risky, all risky in figures 3a and b. The capital growth rates were maximized when the risk-adjusted discount rate was equal to M equals 0.25, where, as shown in figure 2, equal investment in long-term investments from both functions would absorb all the budget. The relative insensitivity of GF and PF to RRR/RA for values of R sub A less than M equals 0.25 for most risk misperceptions, and somewhat less so for RNPV/R sub A, was because the budget, on the average, was exhausted before all of the acceptable long-term investment opportunities were selected. Thus, the budget tended to be invested in approximately equal amounts of safer and risky long-term investments. However, when R sub A greater than 0.25 and for all risk misperceptions except when all opportunities were perceived safer, funds were diverted to either risky long-term investment opportunities from the safer ones, all reverse. Because the risky ones were misperceived as acceptable or short-term investments, all correct, all risky, because all long-term investment opportunities viewed acceptable in both risk classes had been selected before the budget was exhausted. It is clear from figures 3a and b that accuracy in risk assessment is important to derive the benefit of a high GF and a low PF. With a few exceptions, the capital growth rates were as good or better and the risks of ruin less or no worse for the situation where all opportunities were classified correctly than for the other three situations involving risk misperceptions. For the extreme case of reverse perception, the risk of ruin was dramatically worse than random selection. The benefits of risk reduction in RRR/R sub A and RNPV/R sub A, thus, are due largely to diverting funds from risky investments to either safer long-term investments or market investments to the extent the decision maker does a reasonable job of risk classification. Similar experiments were conducted using R equals M equals 0.25 as the risk-fee discount rate for long-term investment opportunities perceived safer. The results and observations were comparable to those above. The principal difference was that, in general, more funds were diverted to short-term investments as the risk-adjusted discount rate was increased since safer long-term investments with IRRs between I equals 0.10 and M equals 0.25 were now unattractive. The effect was to generally lower most of the values of GF and PF. Experiment 2. The performance of RPP/N sub A. Figures 4a and b show the performance of RPP/N sub A for a range of cutoff payback periods between 3.5 and 0.75 for risky long-term investment opportunities. Figure 4a shows the results when the risk-free discount rate used to compute the payback period was R equals I equals 0.10, and Figure 4b shows the results when R equals M equals 0.25 was used. Figure 4 omitted. The cutoff payback period for long-term investment opportunities perceived safer was 5.0. This value was chosen because it guaranteed that no long-term investment opportunity perceived safer would be rejected for failure to satisfy this hurdle, since all the long-term investment opportunities generated in these simulation experiments had a payback within 5 periods. In examining figures 4a and b, it is important to recognize that the discount rate used had a significant effect on the payback period computed. A long-term investment opportunity discounted at a higher discount rate yields a longer payback period. The maximum finite payback period of an opportunity is equal to the number of periods to the last cash flow, which occurs when the discount rate used is equal to the opportunity's IRR. Thus, the payback periods for opportunities with IRRs less than the discount rate used would be undefined, since these opportunities would never pay back. In this study, such opportunities were assigned an infinite payback period. Hence, for a finite cutoff payback period, N sub A, any risky long-term investment opportunity with an IRR less than the discount rate used was rejected. Consequently, for a given discount rate, the RPP/N sub A decision procedure would reject at least a subset of long-term investment opportunities that would also be rejected had RNPV/R sub A and RRR/R sub A been used. Thus, the application of RPP/N sub A, in a limited sense, is an implicit application of RNPV/R sub A and RRR/R sub A. Note in Figure 4a, when the decision-maker perceives all long-term investment opportunities as safer, that is, only the risky ones are misperceived, GF and PF plot as horizontal lines, thus exhibiting their independence of the cutoff payback period, N sub A. In this case, the decision-maker selected long-term investments by RPP until the budget was exhausted. The capital growth rate was higher than random selection, but the risk of ruin was also considerably higher. By comparison with Figure 3 for the same situation, the capital growth rates for RNPV/R sub A and RRR/R sub A were higher, both relative to random selection and to RPP/N sub A, and the risks of ruin were lower. Figure 3 omit T, since RPP/N sub A is not designed to address maximization of future wealth. Such comparisons of the capital growth rates involving RPP/N sub A are not particularly meaningful. However, payback period is advocated as effective for dealing with risk, and it is particularly interesting to note that a comparison of the risks of ruin suggests that selecting long-term investments on the basis of RPP until the budget is exhausted may be worse than doing so on the basis of RNPV and RRR, and even random selection. The reduction in the risks of ruin accomplished by RPP/N sub A. For lesser values of N sub A, when the decision-maker either perceived the risks of all the long-term investment opportunities correctly or perceived all long-term investment opportunities as risky, was achieved simply by reducing the fraction of the budget. invested in risky long-term investment opportunities, and investing the funds either in safer long-term investment opportunities, all correct, or in short-run investments, all risky. It is noteworthy that the risks of ruin were higher than random selection for almost all values of N sub A. The exception occurred when the risks of all long-term investment opportunities were perceived correctly, and N sub A was so reduced that virtually all of the budget was invested in either safer long-term investments or short-term investments. As observed with RRR/R sub A and RNPV/R sub A, reverse perception resulted in the worst exposure to the risk of ruin. Similar observations can be made from Figure 4b. The most notable effect from raising the risk-free discount rate from R equals I equals 0.10 to R equals M equals 0.25 to compute the payback period was the impact on the risks of ruin. For values of R greater than 0.10, the performance of RPP/N sub improved, GF was higher and PF was lower. Because the budget was more fully invested in the better long-term investment opportunities whose IRR greater than 0.25. Because of the implicit application of the decision procedures RNPV/R sub A or RRR/R sub A discussed above. In these simulation experiments, only about half of the long-term investment opportunities were according to RPP/N sub A. Hence, for the shorter values of N sub A, the rank ordering of long-term investment opportunities according to payback period was often irrelevant because frequently all the acceptable opportunities were accepted. The results here are similar to RNPV/R sub A when R sub A equals 0.25 and all the long-term investment opportunities are perceived as risky. Thus, RPP/N sub A when R sub A equals 0.25 drew mostly upon the inherent capability of RNPV/R sub A or RRR/N sub A, since the RAN ordering of the values of payback period did not materially affect the selections. For shortened values of N sub A, the improvement in PF for the situations where all long-term investment opportunities were perceived either correctly or risky was due merely to diverting funds from long-term investment opportunities that failed to meet the cutoff payback period to either safer long-term investments or short-term investments, since all acceptable opportunities satisfying the cutoff payback period we accepted and ranking was irrelevant. It is interesting to note by comparing the curves in Figure 3a and B with the curves in Figure 4a that, in general, RRR/R sub A and RNPV/R sub A performed better, higher GF, lower PF, than ROPP/N sub A. A point-to-point comparison, however, is not possible since there is no basis to match particular values of R sub A to particular values of NA except, of course, for the situation where all long-term investment opportunities are perceived as safer and the values of R sub A and N sub A are irrelevant. It appears that the benefits of ROPP/N sub A arise mostly from the implicit application of the hurdle to reject long-term investment opportunities with positive NPVs. In all cases, the benefits in reducing the risk of ruin by shortening the cutoff payback period were derived by simply reducing the fraction of the budget invested in risky opportunities to safer investments. As observed in Experiment 1, it is important to assess the riskiness of opportunities accurately. Experiment 3. The performance of RNPV/N sub A. Figure 5 illustrates the performance of payback period as a secondary measure when used with RNPV as the primary criterion. Figure 5 omitted, for this experiment, the risks of all long-term investment opportunities were perceived correctly. Figure 5 shows the effects of variation in N sub A as well as R. Variation in the risk-free discount rate was included to observe the effect of such variation in combination with variation in N sub A. The capital growth rates decreased with both shorter cutoff payback periods and/or higher discount rates. Reducing the cutoff payback period, of course, results in rejection of some risky long-term investments with otherwise acceptable NPVs. For lower values of R, where the total cost of long-term investment opportunities exceeded the budget, funds that would have otherwise been invested in long-term investment opportunities had they not been screened out by payback period were diverted to other long-term investment opportunities with a lower NPV and an acceptable payback period. However, for higher values of R, where the total cost of acceptable long-term investment opportunities was less than the budget, the funds diverted went instead to short-term investments. Figure 5 illustrates a general trend of a decreasing risk of ruin and corresponding decrease in the capital growth rate, as funds were diverted to either less economical long-term investments or short-term investments with increasing discount rate. However, a less consistent trend occurs with decreasing cutoff payback period. While the capital growth rate decreased noticeably with increased cutoff payback period, the risk of ruin changed less dramatically and less consistently. For R equals 0.10 it increases, for R equals 0.35 it decreases, and for R equals 0.25 it does some of both. Figure 5 generally suggests that the use of payback period as a secondary measure has a marginal effect on controlling the risk of ruin, but it can have a significant detrimental effect on the capital growth rate. Experiment 4. The performance of RNPEV/beta. Figure 6 shows the results of the performance of RNPEV/beta for values of beta equals 0.0 and 0.10, and risk-free discount rates between 0.20 and 0.40. Figure 6 omitted. It is to be remembered that for RNPEV/beta, only the risk-free discount rate is used to compute the NPV for all long-term investment opportunities, both safer and risky. Further, recall for RNPEV/beta that an error in risk assessment means that the decision maker erred in estimating an opportunity's cash flow distributions to such a degree that a risky long-term investment opportunity whose true risk is acceptable will be misperceived as unacceptable, whereas one whose risk is unacceptable will be misperceived as acceptable. The curves of GF and PF for values of beta equals 0.0 and 0.10 are for the situation where the decision maker classifies all long-term investment opportunities correctly. When beta equals 0.0, all the long-term investment opportunities generated from the risky investment opportunities investment function were rejected, thus making substantial funds available for either safer long-term investments or short-term investments. As the discount rate was increased, the result was to divert funds from safer long-term investment opportunities to short-term investments. The substantial amount of capital invested in the market assured that the firm did not suffer ruin and, therefore, the risk of ruin was zero for all R. As the value of beta increased, more long-term investment opportunities from the risky investment opportunities function were accepted, with a corresponding decrease of capital invested in the market, increasing both GF and PF. In this study, a value of beta equals 0.20 was sufficient for all long-term investment opportunities to have an acceptable risk. Thus, the curves all correct approach the situation where the decision maker misperceived the risky long-term investment opportunities as safer ones, all safer, as shown by the solid arrows. In a sense, this later situation, all safer, represents the upper bound on GF and PF with respect to beta for a decision maker who assesses risks accurately. For the situation where the decision maker misperceives safer long-term investment opportunities as risky, all the long-term investment opportunities were rejected because their perceived risks were unacceptable, and thus the budget was invested entirely in short-term investments. Thus, GF equals 0.10 and PF equals 0.0. This situation, all risky, represents, in a sense, a lower bound for beta. The situation where the decision maker misperceives both risky and safer long investment opportunities is shown for beta equals 0.0. Values of beta between 0.0 and 0.20 would produce curves in the region shown by the dashed arrows. As noted before, a discount rate of M equals 0.25 maximized GF for the situation where the decision maker perceived all the long-term investment opportunities as safer. The risk of ruin was reduced by either increasing the discount rate, R, or decreasing the acceptable probability of risk, beta. Figure 6 indicates that, in gene, decreasing beta for a given discount rate reduced the risk of ruin more than otherwise could be gained for a given beta and increasing the discount rate. It is so noted, again, that estimating the riskiness of long-term investment opportunities accurately is important to realize the benefits of the risk restriction. Experiment 5. Preference for short-term capital recovery. A final experiment investigated the notion that recovering one's investment sooner than later reduces one's exposure to risk. Payback period, in particular, favors such a policy by selecting long-term investment opportunities that return the investment sooner. In this experiment, two firms were simulated. The characteristics of the long-term investment opportunities were the same as in the previous experiments, except that one firm generated only long-term investment opportunities with lives of 1 period and the other firm generated long-term investment opportunities with lives of 5 periods. On the later case, cash flows occurred over the 5 periods, not just at the 5th period. Both firms judged the riskiness of long-term investment opportunities correctly, and they used RNPV/R sub as the decision procedure with values of R sub equals 0.20, 0.25, and 0.30. The results are as follows. Results omitted. The differences between the values of GF for the two firms were not as striking as the differences in PF. In the situation simulated, the preference for short-term capital recovery not only failed to reduce the risk of ruin, but it actually increased it drastically. Although the firm with the short-lived investment opportunities invested a larger amount of funds at each decision time, and this large turnover resulted in a diversification, which is consistent with the desire to reduce the risk of ruin. Another form of diversification occurred in the other firm that was obviously more beneficial. The budget at each decision time for the firm with 1-period investments was comprised of returns from investments in the immediate preceding period only, whereas for the firm with 5-period investments, it was comprised of returns from the 5 preceding decision periods. The result was that this longitudinal budget diversification had a greater effect on reducing the risk of ruin in the later firm than in the former. In effect, the random cash flow outcomes from several preceding decisions had a significant ameliorating effect on the risk of ruin that was absent when random cash flow outcomes were based solely on the immediately preceding decision. Thus, frequent reinvestment does not necessarily reduce risk. Conclusion. The decision procedures relying on subjective assessment of an opportunity's riskiness, RRR/R sub A, RNPV/R sub A, RPP/N sub A, and RNPV/N sub A, proved, in general, to be marginally effective in dealing with the risk of ruin and attaining the decision-maker's objective of maximizing future value. The reduction in risk of ruin attained by either increasing the risk-adjusted discount rate or decreasing the cutoff payback period by these decision procedures was due principally to diverting funds to either safer long-term investment opportunities or market investments rather than to any inherent risk assessment. This was not unexpected since these decision procedures do not measure risk. They only reduce the economic attractiveness of opportunities the decision-maker deems risky. Further, accurate assessment or perception of an opportunity's riskiness is important to gain the benefits of attaining higher capital growth rates and lower risk of ruin with these decision procedures. Indeed, under some circumstances, one can do worse than random selection. Payback period was reasonably effective in achieving capital growth rates near those attainable with the other logical decision procedures, but it was especially ineffective in dealing with risk. The decision procedure based on objective assessment of risk, RNV, was more effective in achieving high capital growth rates and controlling the risk of ruin. Like the other decision procedures, however, accurate risk assessment was important to gain from its benefits. Finally, the decision strategy to prefer long-term investment opportunities with short-term capital recovery periods rather than longer periods was not only an ineffective strategy for controlling risk, it actually increased it drastically. The use of Monte Carlo computer simulation, of course, does not provide exclusive proof of the performance of capital budgeting decision procedures for dealing with risk for all situations. However, the methodology does offer opportunities to gain insights under fairly complicated and realistic scenarios that serve to enrich our understanding of the relative performance of these techniques. Introduction. Risk-oriented corporate management. especially enterprise risk management, (ERM), aims to preventively address risks while fostering opportunities, moving beyond traditional risk management. McShane 2017. Hunziker 2019. Numerous studies confirm that sustained economic success depends on the type and extent of risks taken, making risk management crucial to success, e.g., Krauss and Say 2016, Arfold et al. 2018. Joyce and Mayer 2012 indicate that low fundamental risk brings higher stock returns. The relevance of idiosyncratic risks, like those common in imperfectly diversified capital market operators, further justifies risk management, and the volatility anomaly reflects the well-known risk-return paradox. Budd 1993, Bowman 1980. In their meta-study, Horvey and Odi-Mensah 2023 also find that comprehensive ERM enhances profitability and value. We, therefore, believe that a sound risk management approach should inform management about potential crises timelessly, risk management as an early warning system, and provide information on risk exposure to facilitate decisions by making it possible to weigh risks against returns, risk management as a decision-oriented system. Recent publications on risk management, including Hardy and Saunders, 2022, Fraser et al., 2021, Fruit et al., 1993, Kaplan and Mikes, 2012, 2016, and Nako and Stulls, 2022, highlight a developing emphasis on integrative risk management and risk culture. Additional guidance comes from standards developed by the Committee of Sponsoring Organizations of the Treadway Commission, COSO, and their ERM framework, Hunziker 2019, and Risk Governance Approach, as discussed by Stein and Weidman, 2016, which extends and evolves ERM. Alternative frameworks such as those by Stein and Weidman, 2016, Kaplan and Mikes, 2016, and Mthian et al., 2022, who focus on SMEs in developing countries, aim at improving risk management. While these publications have closed major gaps in the literature on conceptions of risk management, ERM concepts still focus on existing risks and potential mitigations, often overlooking how each action, especially strategic decisions, alters a company's risk exposure and do not adequately address value creation based on risk information. This weak link between risk management and strategic decisions has complex roots. First, the importance of risk information in decision-making in general is sometimes undervalued, since many companies treat risk management as a kind of bookkeeping, as though risks were static, not adequately addressing the dynamism of risks as part of decision-making. Second, the two methods, aggregating risks based on corporate planning and linking the overall scope of risk with enterprise value as a decision criterion, receive scant attention in the ERM literature. Even current textbooks on quantitative ERM rarely discuss key topics such as risk aggregation. The deficits in most publications and frameworks are mirrored in the methodological gaps in available risk management systems, despite the fact that most managers now recognize that a focus on legal compliance is too narrow. Horvey and Ankema 2020, and cannot aid decision-making. By placing risk management in the strategic context of sustainable corporate safeguarding, making it decision-oriented, and aligning it with value-based management, we diverge from existing frameworks. Our integrative approach addresses key challenges in modern companies, such as the inclusion of new kinds of risks like ESG risks, economic, social, or governance, and improves resilience to economic and geopolitical risks, all of which form part of a holistic risk management approach. In this paper, we first outline the robust enterprise framework before detailing the outer layer of this framework, competence in risk management, divided into 7 key areas of development: risk identification, risk quantification, risk aggregation, decision orientation, value contribution of risk management, integrative risk management, risk culture and communication, We then present insights derived from a concise literature analysis, examining the coverage of these 7 areas in the existing literature before providing the conclusion. The 7 areas we identify are covered in various risk management standards and maturity models, but these standards and models do not always explicitly name or emphasize these areas. Our areas are therefore not derived from a single standard or publication, but are instead based on our own experiences and the wider literature. 2. Robust enterprise framework. For long-term success and resilience, we propose adopting the robust enterprise framework, characterized by Gleisner, 2023, and shown in Figure 1. Financial sustainability at the core, aiming at a stable rating and/or low earnings risk. A robust strategy focusing on stable strategic potential for success, driving future financial performance and enterprise value. High competence in managing risks, both opportunities and threats, especially in decision-making. Here, risk management is not a separate function, but rather one layer of a wider framework centered on financial sustainability and enclosing a robust strategy. These elements are detailed below. 2.1. Financial sustainability. Robust enterprises aim at high financial sustainability, Gleisner et al. 2022, that emerges when the following occur. 1. The enterprise at least matches the growth of the industry, in real terms and over the long term. 2. The risk-dependent probability of insolvency, P, is low. 3. The earnings risk, expressed by the coefficient of variation, V, of profits, is acceptable to the owners. 4. Capital returns exceed the risk-based cost of capital. High financial sustainability implies low risk of insolvency and a favorable risk position. Ensuring such sustainability serves as a secondary condition for owners seeking to limit risk, Telser 1955, Kataoka 1963. Financially stable companies are less risky and generate significant risk-adjusted excess returns over the long term, Gleisner et al. 2022. 2.2. Robust strategies. Ensuring financial sustainability requires a robust strategy, and recent research has sought to identify the strategies that foster resilience during economic crises, IUB 2014, Buchner et al. 2021. Novak et al. 2021. A robust strategy is grounded in core competencies that have long-term value and are versatile and difficult to replicate. Such strategies create competitive advantages, enabling companies to differentiate themselves from competitors and retain customers. This allows companies to pass on cost fluctuations to business partners while avoiding unattractive fields of activity and customer groups, as well as critical dependencies. The value chain retains only those activities that cannot be outsourced, and operations maximize simplicity while balancing cost, risk, speed, and quality considerations. Resilience is maintained by duplication of main resources, a competent workforce, and a financial cushion. Where possible, conditions aim to support self-organizing, agile structures that offer employees the freedom and incentives to act flexibly yet accountably. Diversifying and limiting losses and liabilities protects solvency from unexpected and negative events. Robust companies pursue strategies that are likely to ensure at least a sufficient minimum rating, even during major crises. Along with a robust strategy, an effective risk early warning system is needed, particularly to identify strategic risks. Quantifying early warning signs also helps with planning. 2.3. Competence in managing risks. Addressing opportunities and threats, risks 1, is vital to sustainable success. All employees should address risks openly and proactively. Deficits in existing risk culture, e.g., reckless behavior, must be addressed, Coons and Heights 2021. This should be accompanied by a sound methodology due to the central importance of understanding risks when pursuing positive outcomes, Kaplan and Mikes 2012. Since it is usually not an individual risk, but rather a combination of risks that precipitates crises, risk aggregation based on risk quantification is crucial. The two most relevant frameworks, the COSO ERM framework, COSO 2017, and the ISO 31000 standard, ISO 2018, stress the importance of a portfolio view, hinting at risk quantification and risk aggregation, but permit qualitative approaches, a central weakness. Instead, we argue that only consistently quantifying all relevant risks as part of risk aggregation will render a portfolio view. We, therefore, now move on to a discussion of the major components of sound risk governance. 3. Sound risk governance. Robustness and resilience improve through early crisis detection via risk analysis and aggregation, making as important as robust strategy and financial sustainability. An integrative risk management approach focused on supporting business decisions and tied to corporate planning via risk aggregation becomes the foundation of management control. The strategic, decision-oriented development of has many commonalities with risk governance. See Stein and Weidman 2016, Stein et al. 2019, Weidman et al. 2022. As ERM's decision orientation aligns with the risk governance approach, see, for example, Weigel et al. 2018. Moreover, risk governance is integrative, emphasizing the importance of involving all employees in risk culture. The highest maturity level is reached when all employees consciously manage risk, embedded risk management. Thus, risk governance supplies a suitable framework for improving resilience and robustness. This strategic form of risk management becomes essential for success and management control. Below, we detail 7 areas for improvement, see Figure 2, using embedded risk management as the new paradigm. This builds on existing considerations as outlined in COSO 2017 and Nocco and Stolz 2022. We show how requires further development to become foundational to corporate success. 3.1. Risk identification. A well-designed system analyses strategic, financial, operational, and hazard risks under a single overarching process, AI et al. 2016, page 1. Both the COSO framework and ISO 31000 stress that risk management should be about linking business objectives to risk and integrated with strategy setting and performance, COSO 2017, page 10. Similarly, ISO 31000, page 2, states that the purpose of risk management is the creation and protection of value, and that risk management should be a part of the organizational purpose, governance, leadership and commitment, strategy, objectives, and operations. Despite this mention of operational and strategic risks, many companies focus solely on operational risks, such as potential failures of critical machinery. Though these are relevant, a company's overall risk exposure is mostly determined by strategic and macroeconomic risks, which tend to be more severe. Consequently, during risk analysis, the company's business model and strategy must first be examined for strategic risks arising, for example, from threats to key success factors. Serious threats to the company's existence often result from macroeconomic risks and crises, which can create sharp drops in demand, rising inflation, interest rates and raw material prices, and supply chain disruptions. Key strategic and macroeconomic risks should, therefore, be systematically monitored and analyzed. These can stem from the following: threats to individual success potentials or the business strategy as a whole, often arising from technological or societal trends. Changes in competitive forces in the industry environment, e.g., removal of barriers to entry, increasing dependence on customers or suppliers, availability of substitutes. The macroeconomic environment. Threats to a company's potential for success can also arise if it fails to meet stakeholder expectations regarding the stability of the business model. Here, so-called sustainability risks arise, which can be reduced by introducing an ESG, economic, social, or governance framework, such as one based on ESG scoring as a guideline, El Ghul et al. 2018, Gupta 2018. A sound sustainability strategy requires systematic identification of relevant sustainability risks in all 3 ESG areas. Risk identification should cover all potentially relevant risk areas and then focus on the most relevant ones for quantification, as resources are limited and these risks may have the highest impact. This does not mean excluding risks below the threshold altogether. Risks that occur regularly and only have a minor impact can be quantified via modeling of fluctuations in items such as sales or material costs to be included in the overall risk exposure. 3.2. Risk quantification. Many companies describe risks in terms of probability and expected damage, but this is seldom justifiable, as many risks cannot be described in this way. Risks differ in nature and require a quantitative description that models risk characteristics. Even event-oriented risks such as catastrophic IT failures have uncertain impacts, which should be modeled in the form of a range. Orlando 2021. An ERM system should use adequate probability distributions to form a sound foundation for risk aggregation. Vose 2008. Hargreaves 2021. Sustainability risks must also be quantified to assess their contribution to risk exposure, which is challenging as the effects are both financial and non-financial. In addition, we must quantify the consequences of the indirect effects of the company's business activities on the environment and society, and vice versa, and on its own reputation, which, in turn, influence sales and cash flows. 3.3. Risk aggregation. Neither the COSO ERM standard nor the bulk of the literature elaborates on the risk aggregation method required for decision-oriented risk management. References to risk aggregation are primarily found in countries where aggregation is required by law, as is the case in Germany. Berger and Gleisner 2018. Without risk aggregation, however, it is impossible to evaluate the combined effects of individual risks on target indicators. Even risk management scholars often limit the use of Monte Carlo simulations to risks where there is a wealth of historical data or to large companies. However, we have implemented such systems in smaller companies to quantify low-frequency risks or personnel risks. Some authors also distinguish between controllable and non-controllable risks, e.g., Kaplan and Mike's 2012, 2016, but this is neither necessary nor useful. Both categories together determine the overall scope of risk, insolvency risk, and the need for equity to cover risk. Aggregating quantified risks using a Monte Carlo simulation enables a well-supported assessment of insolvency risk, Saha and Malkiel 2012, from which a bandwidth plan can be derived. This creates transparency and allows for the calculation of equity and liquidity requirements in line with risk. In particular, it provides a basis for balancing risks and returns in decision-making. Furthermore, risk management and corporate finance benefit from calculating equity requirements. 3.4. Decision orientation. All management decisions have uncertain effects because they are associated with opportunities and threats, that is, risks. Risk mitigation measures affect the scope of risk, but so do decisions to invest, alter strategy, acquire, or improve ESG scores. Accordingly, properly comparing the risk, return profiles of various options requires clarity about how the risk scope might change with each available option. In other words, hypothetical risks, those that would arise as a result of decisions that have not yet been taken, must also be considered. Ordinary risk management systems primarily monitor existing risks to summarize the risk situation in a standardized format. However, this information is rarely incorporated into business decisions, limiting economic benefits. Risk management that focuses solely on transparency will fail to properly serve company interests. Risk management analyses, therefore, must be included when preparing business decisions. This enables management to consider underlying risks and their potential effects before a decision is made. The concept of a decision-oriented approach to risk management is found in COSO's ERM standard, Hunziker 2019, in Stein and Weidman's 2016 risk governance concept, and in Beasley and Branson 2022. 3.5. Value contribution of risk management. Reducing cash flow volatility improves planning certainty and reliability, Amit and Werner felt 1990. Predictable cash flows reduce the likelihood of forced reliance on external financing sources and defaults, Lee and Wu 2009. Krauss and Say 2016 confirmed that risk management increases firm value and returns, while reducing return and cash flow volatility. In many companies, risk management, management accounting, and value-oriented management approaches are siloed. Firms derive the value driver, i.e., the cost of capital or discount rate, from historical stock returns, so enterprise value and value-based performance measures fail to consider changes in the scope of risk, leaving management quasi-risk blind. Risks are excluded from decision-making in these capital market-oriented approaches, and risk management systems remain isolated. No meaningful information exchange occurs between management systems, and potential synergies are lost. Hunziker, 2019. Gleisner, 2019, and Ernst, 2022, show that traditional finance approaches, especially CPM, cannot be used to calculate the value contribution of risk management via the cost of capital. See Gleisner and Ernst 2023 with a case study on simulation-based company valuation. Assuming imperfect capital markets, no model of perfect markets, including the CPM, should be used to derive the cost of equity, and insolvency should always be seen as possible. See Schliefer and Vishny 1997, Campbell et al. 2008, Joyce and Mayer 2012, Dempsey 2013, Fama and French 2015, Rossi 2016, Fernandez 2019. Figure 3 shows how the cash flow (CF) distribution and default probability can be determined via risk aggregation and how this informs valuation. Such methods allow us to deduce the expected value (ECF) and the cost of capital directly from the scope of risk via a risk measure, R, such as standard deviation or value at risk. Dorfleitner and Gleisner 2018. The probability of insolvency, often overlooked but acting as a long-term negative growth rate, must also be taken into account. Gleisner 2019. 3.6. Organization-wide integrative risk management. In embedded risk management, the central idea is that risk management is decision-oriented and uses existing resources, processes, and tools, such as those employed for planning and budgeting. This improves the efficiency and acceptance of risk management organization-wide. Integrating essential risk management tasks into other management systems should be commonplace. Berger and Gleisner 2018. For example, risks can be identified while planning and budgeting by recording the underlying assumptions, each of which is, by definition, uncertain and, therefore, a risk. Quality management can easily analyze and monitor technical risks using proven tools, such as failure mode and effects analysis. Essential risk management tasks can thus be included within the controlling, corporate planning, and budgeting processes. Gleisner 2020. A. Planned values and budgets are based on assumptions, e.g., raw material prices. Every uncertain assumption is a risk. Therefore, it is efficient to explicitly record all assumptions as part of the planning process and to share this information for risk management. B. A new risk is identified whenever a deviation from the plan is caused by an as-yet unrecorded risk. C. Strategic management and control systems, e.g., the balanced scorecard, are used to implement corporate strategy by clearly describing strategic objectives expressed as key performance indicators, KPIs, and assigning measures and responsibilities. Assigning risks to key indicators reveals whether they can trigger deviations from the plan, augmenting the traditional scorecard approach. Those responsible for a particular metric then monitor the associated risks, which incentivizes employees to identify risks that can cause deviations. Moreover, deviation analysis makes it possible to assign responsibility for deviations that have occurred according to their cause. As a rule, the effects of exogenous risks cannot be attributed to those responsible for the performance indicator in the performance assessment. In order to implement a risk management system with a decision-oriented focus, we must seamlessly connect risk analyses to decision-making. This requires cooperation between risk management and management accounting, or the department responsible for preparing major decisions. See Section 3.4. 3.7. Risk culture and communication. Risks are unpleasant, and people often neglect unpleasant information, failing to develop necessary routines. Consequently, their ability to correctly assess risks intuitively is underdeveloped. Societies, industry practices, market competition, and occupational practices also influence the process. While these influences cannot be eliminated, cultural issues must be addressed to steer an organization toward a desirable risk culture, Coons and Heights 2021. These are the aims of risk communication and risk culture, Pan et al. 2020, ideally based on a sound risk policy. Risk policies must align with the normative elements of corporate management, e.g., decision rules and ethical norms. Here, risk policy is a matter of documented behavioral rules aligned with corporate values. As the COSO framework states, culture supports the achievement of the entity's mission and vision, COSO 2017, page 27. Definitions of risk culture often reference norms, values, and beliefs surrounding risk awareness, risk-taking, and decision-making. They also stress the importance of individual perceptions and cognitive processes, Coons and Heights 2021. Risk culture manifests itself in definitions of key terms, key indicators and dashboards, or the definition of roles and responsibilities. Risk policies address, for example, decision criteria for weighing risks against profits, individual risk limits, and risk-bearing capacities, offering a starting point for creating a risk management organization that both documents behavioral rules involving all staff in the handling of risk, but also lays the foundations for an enduring, established risk-conscious culture. To effectively communicate risks, risk management systems must provide information in a format that supports the decision-making process. Risk communication mostly relies on lists and explanatory text, sometimes accompanied by ratios such as RORAC, return on risk-adjusted capital, and can be improved by adding charts and diagrams. The design of graphs is critical for transparency and functionality. People often fail to correctly interpret risk information from visual displays, e.g., Berger et al. 2022, Garcia-Redimero and Coakley 2013, Bao et al. 2017. To overcome issues such as distortions and end anchoring, guidelines on the correct design of graphical displays in reporting should be followed. These issues deserve attention, as reports determine how people perceive a system, which then affects their decisions. We now analyze how these 7 areas are covered in the existing literature analysis on systems. 4. Literature analysis. We used Horvey and Odi-Mensah's 2023 meta-study, which analyzed 37 studies on the measurement and performance of to examine the coverage of the 7 areas of development. We defined a question for each. Risk identification. Do the authors include strategic and macroeconomic risks? Risk quantification. Do the authors mention risk quantification? Risk aggregation. Do the authors stress that risks must be aggregated via simulations? Decision orientation. Do the authors stipulate that risk analysis must be linked to business decisions? Value contribution. Do the authors mention how risk management can improve firm value? Integrative risk management. Do the authors view risk management integratively? Risk culture and communication. Are risk culture and communication referenced? In Table 1, we assigned a yes if the authors elaborated on these topics, 2 partly if the authors included a literature reference only, pointed to a standard, or included a relevant term but provided no details, and no if the topic was not addressed in one of the above ways. Our analysis is obviously limited as we used only the publications included in Horvey and Odi-Mensah 2023. In addition, we reviewed that document as it stood without contacting the researchers. It is, therefore, possible that the authors addressed all 7 areas in their research, but included only a short or no reference in the publication. Our categorization is also open to challenge, as such groupings are always somewhat subjective. We nevertheless believe that this analysis supports our view of these 7 areas as crucial to the theoretical and practical improvement of integrated risk management systems. We analyzed all the sources featured in Horvey and Odi-Mensah's 2023 literature review, not biasing the analysis with our own filtering process. These publications offer consensus only for the integration of risk management, with most papers insisting that risk management be integrated, perhaps because Horvey and Odi-Mensah explicitly focused on ERM-related studies. Similar reasoning explains why many of the studies discuss the value implications of ERM. Horvey and Odi-Mensah explicitly use the term value of ERM in their analysis. The other 5 areas are inadequately covered in the empirical literature. Particularly surprising is the treatment of risk aggregation, which only 6 publications include more than a passing mention of. Bonard et al., 2018, one notable exception, states that by aggregating risks into one risk portfolio, firms are able to improve the understanding of their overall risk exposure, page 3. Using Standard & Poor's ERM rating, S&P Global 2005, as a proxy for the quality of an ERM system, they found a positive relation to the value of an insurance company. The COSO ERM framework also mentions such a portfolio view, although it is unclear whether this is based on a thorough risk aggregation like that provided by Monte Carlo simulation. Farrell and Gallagher, 2015, also mention risk aggregation, noting that the ultimate goal of ERM is to model, measure, analyze, and respond to risks in a holistic manner, treating each risk exposure not in isolation, but rather in a portfolio context, page 625. Grace et al., 2014, are the only ones who include simulations to aggregate risks as part of a maturity model. Some publications do therefore highlight the importance of risk modeling, aggregation, and other important areas for developing meaningful, effective, and integrated risk management, but this is not adequately emphasized. Companies frequently pay inadequate attention to this when implementing risk management systems, resulting in poor risk cultures where risks are neither quantified nor considered in decision-making. In addition, these publications describe risk aggregation as a standalone tool for deriving risk exposure, but do not elaborate on its integration with business planning, as we suggest. 5. Conclusions. All important strategic and operational decisions should be assessed with reference to the risk-adjusted earnings value, and because of the uncertainties inherent in decisions and actions, all forms of management are in fact risk management. Risk management supports the analysis, monitoring, and management of risks. Personnel skilled in dealing with business opportunities and threats are therefore essential to corporate success, incentivizing the expansion of corporate risk management capabilities. This requires designing a risk management system that can provide the information required for such decisions. We outline 7 areas for development based on assessing current risk management concepts, giving special consideration to the following. A. Decision orientation and links to value-oriented corporate management. Risk management should reveal how the risk scope changes before a decision is made and how this change should factor into the decision calculus. B. Risk quantification, including commonly disregarded risk areas such as economic, geopolitical, and non-financial sustainability risks. C. Risk aggregation procedures that link corporate planning to risk analysis using Monte Carlo simulations, facilitating decision-oriented risk management. Robust strategy undergirds financial sustainability, stable ratings, acceptable earnings risks, and capital returns. Effective risk management means strategic risks that could endanger the enterprise are identified early on and properly considered in decision-making. The integrative, decision-oriented approach of embedded risk management enables as many employees as possible to address identified risks and is highly consistent with risk governance. Our analysis shows that the 7 areas presented in this article, particularly risk aggregation based on corporate planning via simulation methods, are inadequately covered in the literature and should receive more attention. Conceptualization, WG, methodology, WG, data analysis, WG and TBB, data collection, TBB, writing, original draft preparation, WG and TBB, writing, review, and editing, WG and TBB. All authors have read and agreed to the published version of the manuscript. Financial decision-making is a dynamic process that requires a deep understanding of financial principles, risk assessment, and strategic foresight. Effective decision-making involves evaluating available financial data, forecasting potential outcomes, and aligning choices with both short-term and long-term organizational goals. The ability to analyze financial statements, assess investment opportunities, and optimize capital structures ensures that businesses remain competitive and financially stable. Integrating financial management techniques with ethical considerations, risk mitigation strategies, and market trends enhances the quality of decisions and supports sustainable growth. As financial landscapes evolve, decision-makers must continuously adapt by leveraging advanced analytical tools and developing a keen awareness of economic fluctuations. By applying sound financial judgment and incorporating data-driven insights, organizations can maximize profitability, ensure liquidity, and create long-term value for stakeholders. Integrating financial strategy development is essential for aligning financial management with broader organizational objectives to drive sustainable growth and competitive advantage. It involves analyzing financial data, assessing risk, and leveraging investment opportunities to optimize resource allocation and capital structure. By incorporating strategic planning into financial decision-making, organizations can enhance profitability, improve liquidity, and ensure long-term stability. A well-integrated financial strategy considers market trends, economic conditions, and regulatory environments to create a resilient framework that supports innovation and operational efficiency. As businesses navigate an increasingly complex financial landscape, the ability to adapt strategies based on data-driven insights and dynamic market conditions becomes critical in maintaining financial health and achieving strategic goals. Modern information technologies have undergone significant transformations and have become a key element in financial analysis and market forecasting, which have created new tools for influencing the dynamics of the development of global economic processes. The strengthening of the role of technologies of big data analysis, processing of communication and information networks create new approaches to the implementation of financial analysis, ensuring greater accuracy of forecasts and efficiency of investment management. The purpose of the article is to study the role of modern information technologies in the transformation of financial analysis, forecasting, and identification of trends facing financial analysts. The article describes the process of technology integration, which significantly increases the efficiency of financial market analysis and allows governments and companies to better adapt to the changing conditions of the global economic environment. The obtained research results indicate a steady trend towards increasing the role of information technologies in the financial sector, which requires specialists to constantly update their knowledge and skills for the effective use of these tools. The conclusions of the conducted research emphasize the importance of integrating technologies into financial analysis and forecasting, and strengthening the need to develop new strategies and approaches for using digital innovations in the financial sphere. Special attention in the article is paid to the prospects of development of software, information and communication sphere in providing financial analysis and forecasting to improve future innovative trends and challenges that may face the economic global space. Highlights: information technologies, including artificial intelligence, machine learning, blockchain, and big data analytics, have become indispensable in financial analysis, revolutionizing market forecasting and providing crucial support for effective decision-making. The integration of advanced technologies in the financial sector, as exemplified by leading corporations like Goldman Sachs, J.P. Morgan Chase, and Microsoft, not only enhances predictive modeling and risk management, but also underscores the need for continuous innovation and adaptation to changing market conditions to ensure competitiveness and innovation in the global economy. Keywords: information technologies, financial analysis, market forecasting, financial instruments, investment funds, big data. The development of information technologies in financial analysis characterizes a new digital era in the management of financial markets and investment strategies. Technological progress is largely due to the emergence and rapid development of cloud technologies, machine learning, blockchain, big data analytics, and other modern technological innovations. They became revolutionary in revealing complex relationships in financial data that had previously gone unnoticed. The available capacities of data centers allow analyzing large amounts of information that the human brain cannot handle, revealing trends and regularities that are key to making informed investment decisions. Financial decentralization has provided a significant impact on the security and transparency of financial transactions, playing a key role in the development of cryptocurrencies and other forms of digital assets. Big data analytics has changed the way financial analysts work with unstructured data such as news, social media, and economic reports, using that information to gain a deeper understanding of market conditions. The transformation of the economic policy of developed countries with the use of these technologies has far-reaching consequences. The development of digital technologies has prompted the governments of developed countries to rethink their approaches to the regulation of financial markets, currency policy, and macroeconomic planning. Software and its increased power have become central to the development of more accurate economic forecasts and models that enable governments to better anticipate and respond to economic crises and changes. Cryptocurrencies have necessitated a revision of monetary policy and financial regulation, challenging governments to integrate new assets into the traditional financial system as electronic money contributes to the growth of global integration and interdependence of economies. As a result, governments need more coordinated international actions and policies in the field of finance. Forecasting the development of financial markets with the use of modern information technologies is becoming more and more accurate and reliable. The integration of cloud systems into analytical tools has provided the ability for deep and comprehensive analysis of market data that traditional methods cannot cope with, including forecasting stock trends, analyzing consumer behavior, and monitoring economic indicators in real time. Modern technologies significantly increase the ability of specialists to adapt investment and asset management strategies in response to rapidly changing market conditions. Literature review.